members, those who are presenting reports in private limited limited companies, there is a lot of complaints to be made to be done, and we have to be very careful because even as discussing with sir, even ROC is also reviewing the financials of the filed what we have filed, and even NFRA also going through the financials, and so many observations made. There is a lot of mistakes will be done by our chartered accountants while filing for completing their audit report in case of private limited and public limited companies. We should be extremely careful because lot of penalties will be levying on those cases also. So they are penalizing heavily. Request members to take care, and we should understand what are the general common mistakes we do in our financial statement. To make us enlightened on these topics, we have with us Kamal Garg sir. Once again, it should be a very learning session, all of you. Before going live, handovering the session, I want to make some important announcement. Tomorrow we have a full day training session for PV reviewers, and 23rd and 24th we have a 2 days CPE conference in Devraj Arasbhavan. I request members to join for this, and we are starting a GST certification course on from 7th January. I request members to join, and this month, by this month end, you have to comply your CPE fulfillment. Please complete your CPE hours. With this, welcome you all for this program. I request our Treasurer Manjunath Hallu to give a brief introduction of our today's speaker, CA Kamal Garg. Over to you, Manjunath.
Thank you, Chairman sir. Good evening, members. Good evening, CA Kamal Garg ji.
Good evening, sir.
This is my privilege to introduce today's speaker, CA Kamal Garg. CA Kamal Garg is a fellow member of the Institute of Chartered Accountants of India and is a first-class commerce graduate from Deen Dayal Upadhyaya College, Delhi University. He has also qualified post-qualification course in on DISA, Diploma in Information Systems Audit, conducted by CA Institute, and also he is an insolvency professional registered with Insolvency and Bankruptcy Board of India. He has also qualified certificate course on BRSR conducted by ICAI. He was also the member of Board of Studies, Study Metal Research Group in the year 2009-10 of NIRC of ICAI, and a special invitee member of Accounting Standards Board and Financial Reporting Review Group of FRRB, ICAI, and Ind AS Implementation Committee, and many other committees of CA Institute at head office level. And also he has addressed on IFRS for the members of National Board of Accountants and Auditors, Tanzania, East Africa. Besides being a regular guest speaker of IFRS and management development programs at various forums, including ICAI and ICSI, he is also an author of over dozens of books and commentaries on and including IFRS and Ind AS concepts and applications, COVID-19 guide for financial reporting, etc. He has, to his credit, the contribution of Gist of Accounting Standards and Auditing and Assurance Standards for Volume 2 of Company Law, published by BLH, and various articles of NIRC and CIRC of ICI newsletters on FBT, MAT, US SOX compliance, CARO, FEMA, etc. And a series of articles on Delhi value-added tax, taxation, accounting and auditing aspects for the journal tax and corporate referencer. He possesses a rich industry experience in the areas of corporate laws like Companies Act, FEMA, taxation, foreign collaborations, joint ventures, etc., audits and management consultancy. With this brief introduction, I present before you CA Kamal Garg ji. Over to you, sir. Thank you so much.
Thank you, Manjunath ji, for this introduction. And the good thing is you still call it brief introduction, and I am humbled by so much of gratitude you have demonstrated. So with the permission of chairperson, shall I start my deliberation, sir?
Please, sir. Please, sir.
Okay. So good evening to each one of you, and it's a privilege that I'm addressing each one of you. I'm thankful to the Bangalore chapter of ICI, the managing committee, and especially the chairperson, who is my good friend. And I'm happy to see him after so many years, at least on virtual session. So before I share my screen, you must be having one question. Out of my 25 years of experience, one question is constant for each one of the speaker. Sir, will we get the PPT? So let me answer this question first of all. I will share this PPT to the Bangalore chapter and they may then circulate to each one of you. More than the PPT, I have few questions to be asked to each one of you, the participants. Please try to respond these questions. Then obviously I will discuss through PPT. To set the tone, let me share with you some instances. If you people believe that my financial statements are ready, are filed, and nobody's looking after them, it's a misconception. I repeat, if you have this kind of belief that nobody will watch your financial statements, it's a misconception. Some people, some chartered accountants may say that NFRA is not applicable to my client. Then why should I bother? So for example, if I'm not an auditor of a big company, NFRA may not be applicable upon me. Then question may arise, whether should I bother about the financial statements? Answer is a big yes. Why this question is being asked, please take a note of my sentence in your notepad. Even if NFRA is not applicable, even if NFRA is not applicable to your client, still as a chartered accountant, you are under the watch list of 3 regulators. I repeat, you are under the watch list of 3 regulators. Number 1, FRRB of ICI, Financial Reporting Review Board of ICI. Number 2, QRB of ICI, Quality Review Board of ICI. And most importantly, I emphasize, Registrar of Companies. As on date, ROC is active and is sending notices for non-compliance of Section 129 of Companies Act. Section 129 of Companies Act requires that the companies shall prepare the financial statements in accordance with accounting standards and Schedule 3. So if your financial statements are not in compliance of accounting standards and Schedule 3, the ROC may send you a notice for penalizing under Section 129. For this purpose, let me ask you a question. One of my client got a notice from ROC, and in that notice, something like this was written. Show cause why penalty upon you should not be levied because of the following contravention in the financial statements. The contravention which notice mentioned was repairs and maintenance expenses, rupees so and so. Now, my question to each one of you, ladies and gentlemen, is, as per your view, what is the contravention if your financial statements are having a line item, repair and maintenance expenses? So ROC is asking you, why should I not levy penalty upon you? Because your financial statements are having a line item, repairs and maintenance expenses, rupees XYZ. As per your understanding, what will be your stand? What is the mistake into it? Any answer? So I got one answer, plant, building and others. Okay, any other answer? I got one answer from Avinashji. It is not as per Schedule 3. So Avinashji, can you please explain what is the discrepancy? What is the discrepancy vis-a-vis Schedule 3? Sunil Kumarji says for building, for machinery and others. You know, the answer which is coming is that you have to mention the repairs separately for building, for machinery, for others. To that extent, I can accept. But to a larger extent, I will not accept. The major mistake or major discrepancy in this line item, repair and maintenance expenses, that 2 different expenses have been clubbed all together. Repair is an expense which is meant for corrective action. Maintenance is an expense which is meant for preventive action. Now, what happened? The corporate entity has clubbed repair expenses and maintenance expenses under one heading, that is repair and maintenance expense. It is against Schedule 3. It is against Schedule 3. You must be aware. Schedule 3 says that any item of income or expense which is more than the highest of 1% of total revenue or rupees 1 lakh shall be separately disclosed. So you need to check materiality of expenses before you club the expenses. And this kind of minute level technical scrutiny of financial statements, ROC is also undertaking. And that is the reason I must congratulate the chairman of this Bangalore chapter that he has organized this program. Because each one of the member must be aware what kind of discrepancies can be there in the financial statements. ROC is going deep dive. And with all these deep dive scenarios, I will be sharing my PPTs with you. So the way I will be deliberating is, I will be showing you the mistake. Then I will be asking you the question, what is the mistake? So you have to be interactive with me and you have to tell me what is the mistake. So I'm sharing my screen. Please confirm me once my screen is visible. Chairman sir, is my screen visible?
Yes, sir. Yes, sir. We can.
Okay. So I am given two topics. One is common mistakes in the financial statements, and second is the NFRA observation. Very much relevant topics nowadays. And I must again say, each one of the chartered accountant, whether he is into service or is into job or is into practice, he or she must be vigilant about these mistakes. If you are into service, then you cannot say, who will capture me? Please understand, if you're a chartered accountant in service and financial statements contain mistakes, then you can also be penalized as officer in default. ROC can penalize you. And if you are into practice, then obviously the regulators can penalize you in your capacity as financial statements preparer. So to begin with, common mistakes in financial statements, I will start with the legal requirements first of all. If you refer the legal requirements, we have two prominent sections. One is section number 129 subsection 1. Section number 129 subsection 1 says that the financial statement shall give a true and fair view of the state of affairs of the company and comply with the accounting standards as may be notified, and shall be in the form as prescribed in Schedule 3. So what is the connotation coming up over here? Section number 129 subsection 1 says, number 1, that your financial statements shall comply with the accounting standards. And number 2, your financial statement shall be presented as per Schedule number 3. So these two literatures, that is accounting standards and Schedule 3, must be complied with by every company to whom these are applicable. So section number 129 subsection 1 is the management domain. Now, whatever management did, that needs to be reported by the auditor. And that responsibility of auditor is given by section number 143 subsection 3 clause E. Section number 143 subsection 3 clause E says that auditor has to report whether in his opinion the financial statements comply with the accounting standards. And by virtue of SA 200 revised, the auditor also need to report whether the financial statements are in compliance with applicable reporting framework. So a reporting framework is nothing but your Schedule 3. So section number 129.1 is the management duty and 143.3 is the auditor's duty. So let us understand how this legal requirement is getting inculcated in the financial statements. To begin with, we will discuss the common mistakes as per Schedule 2. So you must be aware Schedule 2 is dealing with the useful lives of assets for the purpose of depreciation. So let me ask you question number 1. See this one. All these discussions which I'm having are from practical world only. All these mistakes have been taken from real world only. So you have to tell me that what is the mistake here. At least we can learn from other people's mistake. So we referred one of the annual report. In one of the annual report, this was written. Depreciation on property, plant and equipment is provided on straight line method over their useful lives and in the manner specified in Schedule 2 to the Companies Act 2013. However, in respect of certain plant and machineries and electrical installations, depreciation is provided as per their useful lives, assessed on the basis of their technical evaluation by the external valuer ranging from 20 to 40 years. For your benefit, I can give you a hint. The portion which is highlighted in yellow is having some discrepancy. So my question to the house is, as per your view, what is the discrepancy in this yellow highlighted portion? So one of the answer is you can have one method for one type of asset. Okay. Any other answer? Any other answer? What is the discrepancy? It says certain and not quantified. Okay. Such Schedule 2 depreciation is minimum depreciation and company cannot have any depreciation rate below Schedule 2. Sunil Kumarji, your answer is wrong because Schedule 2 is not giving any minimum or maximum rates. Then there is an answer from Shrimadji. Range is mentioned, not the exact life. Yes, this is the correct answer. Muskan K. Jain says range can't be given. Yes, correct answer. PP cannot have methods of depreciation. Okay. Sunil Kumarji, I mean the minimum useful life. Sunil Kumarji, again, I will say Schedule 2 is not dealing with minimum or maximum life. These lives are only indicative lives. And this will again come up in my next clip also. So the correct answer is range. Range cannot be given. Let us understand what the exact requirement is. So the mistake here is, just see here, as per the requirements of Schedule 2 to the Companies Act 2013, it was viewed that when different useful lives have been used by company for the purpose of charging depreciation on PPEs, such useful lives shall be specifically disclosed by the company by way of notes to the accounts. So useful life needs a specific disclosure. It was thus required that proper disclosures regarding the useful lives of plant and machineries and electrical installations should have been made, identifying the items of plant and machineries and electrical installations with their respective useful lives as estimated by the external valuer. So that specification was absent, and hence this kind of disclosure is a common mistake in the financial statements vis-a-vis the depreciation on property, plant and equipment. Consider this one. From the annual report again, this was extracted. One of the annual reports stated this thing. Schedule 2 to the Companies Act 2013 introduced the concept of useful life of the asset instead of using specific depreciation rates as provided in Schedule 14 to the Companies Act 26. Therefore, the company viewed that Schedule 2 to the Companies Act provides only straight line method of depreciation and any other method cannot be used. So this is one of the accounting policy which we extracted from one of the annual report. Now, please tell me what is the discrepancy over here. For your hint, the discrepancy is lying in this yellow shaded portion. The company viewed that Schedule 2 to the Companies Act provides only straight line method of depreciation and any other method cannot be used. What is the discrepancy here? So I got some answer. Any method can be used. It has to go with useful life asset. WDV or SLM can be used. Mistake is only SLM can be used. Okay. So you would be surprised that the answers which you are giving are also incorrect. So just see what Schedule 2 says. Schedule 2 does not specify any method of charging depreciation, but only provides the indicative useful life of the asset. So please understand, Schedule 2 has prescribed no method of depreciation. It has given only the useful lives, and that too indicative useful lives. The company can use any appropriate method of depreciation such as SLM, WDV, considering the useful life of assets and other requirements as specified in Schedule 2 to the Act. So when we say the method of depreciation, for method of depreciation, we have to go into Accounting Standard 10 rather than Schedule number 2, because Schedule 2 is not dealing with the methods of depreciation. Therefore, the view of the company that Schedule 2 to the Companies Act provides only SLM of depreciation is not correct. I believe you must have understood that the method of depreciation is not given by Schedule 2, rather it is being dealt by AS 10. Now consider the other area. Tell me what is the mistake here. So I'm reading the extract. Property, plant and equipment are stated at cost, net of recoverable taxes, trade discount and rebates, less accumulated depreciation and impairment losses, if any, as computed in accordance with the method prescribed under Schedule 2 of the Companies Act. Intangible assets are stated at cost of acquisition, net of recoverable taxes, trade discount and rebates, less accumulated amortization, depletion and impairment losses, if any, as prescribed as per the method prescribed under Schedule 2 of the Companies Act. What is the mistake here? So one answer is bound to be correct. No method is prescribed. Yes, Prasanna ji, your answer is correct. Impairment is also not prescribed. So what are the scenarios over here? Number one, no method is prescribed by Schedule 2. Second scenario is impairment loss. Impairment provision is not dealt by Schedule 2. Impairment provision is dealt only by Accounting Standard number 28. Or if you are following Ind AS, then Ind AS number 36. So what is the mistake here? Let me have a look out. The mistake is Schedule 2 does not specify any method. We have discussed this thing earlier also. Any method of charging depreciation, but only provides the indicative useful life of the assets. The company can use any appropriate method of depreciation such as SLM, WDV, considering the useful life of the assets and other requirements of Schedule 2. Further, Schedule 2 also does not deal with impairment of assets. Para 2 of Schedule 3 in fact states that for the purpose of the schedule, the term depreciation includes amortization. This is not Schedule 3, it is Schedule 2, typing error only. Therefore, the policy stated by the company is not correct. So what are the two takeaways? Primarily, takeaway number one, no method of depreciation is prescribed by Schedule 2. And second takeaway is impairment losses are not dealt by Schedule 2, rather they are dealt by Accounting Standard 28 or Ind AS 36 as the case may be. See this one. Another extract from one of the annual reports. Depreciation on property, plant, and equipment is provided on straight line method over their maximum useful lives as specified in Schedule 2 to the Companies Act, except where different useful lives are adopted on the basis of technical advice obtained by the company from independent experts. So what is the mistake here in the yellow area? Any answer? So as I discussed earlier also, because somebody put up the answer, then I replied that Schedule 2 is not telling you any maximum or minimum life. They're providing only the indicative lives. And that is the mistake over here. The useful lives as given in Schedule 2 for various types of assets are indicative only and are not minimum or maximum, where the useful lives of various specific assets are the same as those under Schedule 2, the company should use these useful lives. In case the useful life of asset as estimated by the company, supported by technical advice, external or internal differs, that is higher or lower from the indicative useful life given under Schedule 2, the former should be applied by the company for providing depreciation. So what is the takeaway here? The takeaway is Schedule 2 is not prescribing any minimum or maximum useful life. It is merely the indicative life. So this is the kind of mistake which companies in real world have committed. And I believe from this very discussion, you must be aware that what mistakes we should avoid as far as depreciation is concerned. Now, moving forward, consider this thing. Again, one of the extract, depreciation on those assets whose actual cost does not exceed rupees 5,000 has been provided at 100% in accordance with Schedule 2 of the Companies Act. So primarily it is called as depreciation on low value items. So what they are saying, in accordance with Schedule 2, the low value items, that is up to rupees 5,000, have been fully depreciated. What is the mistake here? Yes, Prasanna ji, you are absolutely correct that such low value concept is not there in Schedule 2, and that is the takeaway. The takeaway, Schedule 2 does not prescribe any such requirement to provide depreciation at 100%. Guidance note on Schedule 2 is there, and that guidance note on Schedule 2 states that as the life of the asset is a matter of estimation, the materiality of impact of such charge should be considered with reference to the cost of asset. The size of the company will also be a factor to be considered for such policy. Accordingly, a company may have a policy to fully depreciate assets up to certain threshold limits considering materiality aspect in the year of acquisition. Meaning thereby, if you remember, when it was Companies Act 56, Schedule 14 used to be there. In Schedule 14, there was a concept of low value item. But as far as Schedule 2 is concerned, the low value items to be depreciated fully will be purely based upon your company's policy of materiality. So you have to define materiality as per your own circumstances, and then you can decide to have a full depreciation or an accelerated depreciation as the case may be. Now, let us come to Schedule 3. Schedule 3 is going to be much more interesting than Schedule 2. So let us see what kind of common mistakes people have committed vis-a-vis Schedule number 3. Again, the same thing. Left-hand side column will be depicting the mistakes, and then I will be asking you what mistake you can foresee in this very first column. So for AS compliant companies, I'm discussing whatever discussions I will be carrying out for AS compliant companies are mutatis mutandis applicable for Ind-AS compliant companies also. So I'm skipping the format of balance sheet because that is not important over here. Straightforward coming to the mistake. So from one of the annual report, it was extracted. The Schedule 3 requires all items in the balance sheet to be classified into current or non-current. One of the underlying criteria for such classification is operating cycle. No disclosure was made for operating cycle. So what is the mistake? The mistake itself is self-explanatory. So what I have seen that people are defining operating cycle, people are defining current assets, people are defining current liabilities, but people are not telling, are not disclosing what is the company's operating cycle. So what is the mandatory requirement? If you refer guidance note on Schedule 3, guidance note on Schedule 3 says that you have to disclose operating cycle. So what is the mistake which we need to be careful about? Guidance note recommended that the disclosure about company's operating cycle be given as a part of notes to the financial statement. So what is the learning here? The learning is that as a corporate entity, I have to disclose the operating cycle prevalent for my company. This is a simple one. Let us come to the difficult one in the next one. See here. In one case, notes to account stated that company's operating cycle is 6 months. The sale contract provides for normal credit period of 3 months. However, the company does not expect to receive the payment within 12 months from the reporting date due to ongoing litigation with the customer. So company is not expecting that they will be receiving the payment from the customer within 12 months from the reporting date due to the ongoing litigation. Still, the company classified trade receivable for the customer under current asset category. Is it correct? It must be non-current. It must be non-current, and that is the correct answer given by Charanji also. So what do we need to remember? What we need to remember, this trade receivable is no longer a current asset category. It will be a non-current asset category. The same thing is also given by guidance note. What the guidance note says? Guidance note requires that since the company does not expect to receive the payment within 12 months from the reporting date, the same should be classified as non-current in the balance sheet. So it will be classified as non-current. Please understand, it is not as simple as you are perceiving. I'm going back and I will show you the format of balance sheet. Then I will ask you one question on this very category of discussion. So allow me to go back. Just see here, it is the format of balance sheet. If you see the asset side of balance sheet, on the asset side of balance sheet, we have current assets. Below current assets, we have one line item as trade receivables. If you refer non-current assets, below non-current asset, we do not have any line item of trade receivable. I repeat, if you refer this format of balance sheet, below current assets, we have a line item trade receivable, but such kind of line item, that is trade receivables, is not there in non-current assets. My question to the house is, if you do have non-current trade receivables, shall I add one more point here, point number F, and write trade receivables? Yes or no? If you have non-current trade receivables, shall I add point F here and then write trade receivables? Shall I do this thing? Yes, correct answers are coming. And in fact, some mixed responses are also coming. So what you need to understand, you can take a note of this thing which I'm saying. If you refer guidance note on schedule 3, guidance note on schedule 3 says that, if you do have non-current trade receivables, then these non-current trade receivables shall be shown below other non-current assets. So you need not add a separate line item, rather you have to disclose non-current trade receivables below other non-current assets. Kindly take a note of this thing, otherwise it will be a common mistake. So non-current trade receivables will be shown under non-current assets. The same thing, mutatis mutandis, is also applicable for non-current trade payables. If you see the equity and liability side, below non-current liabilities, we do not have trade payables. So if you do have non-current trade payables, then they will be shown under the other long-term liabilities caption item. Are you getting my point? So you need not present separate line item for non-current trade receivables or non-current trade payables, because these respectively will be shown below the heading other non-current assets or other long-term liabilities, as the case may be. I believe this point is clear to each one of you. So in real world, what I have seen is some people have made a separate line item as a new line item as non-current trade receivables or non-current trade payable, which is wrong, which is not right. Moving ahead now. See this one and tell me what is the discrepancy here. In one case, investments were classified into current and non-current category under Schedule 3, whereas AS 13 requires to classify investments as current and long-term. Still, the company did not make appropriate disclosures about investments under Schedule 3 as to the classification in tandem with AS 13. What is the discrepancy here? Any idea? Any idea what is the discrepancy here? So to make you understand this kind of discrepancy, let me ask you another question. The question is, what is the difference between non-current investments? What is the distinction between non-current investments and long-term investments? What is the distinction between non-current investments and long-term investments? Any answer? Distinction between non-current investments and long-term investments. Charan Kumarji, you're right. This will impact your working capital. But again, my question is still unanswered. My question is, what is the difference between non-current investments and long-term investments? I got an answer from Vishali Desai ji, non-current more than 12 months. But now when we say more than 12 months or less than 12 months, then we need to ask ourselves a question. These 12 months shall be counted from which date? Then Vishali ji, again, you have replied long-term more than 3 years. Balance sheet date. Okay. So I am getting the wrong answers only. It is whatever answers I am receiving are wrong answers. Please take a note if you have a notepad. Schedule 3 bifurcates the investments into current and non-current. I repeat, Schedule 3 bifurcates the investments into current and non-current, whereas Accounting Standard 13 bifurcates the investments into current and long-term. I repeat here. Schedule 3 bifurcates the investments into current and non-current, whereas Accounting Standard 13 bifurcates the investments into current and long-term. And that is why there is a question to be resolved. The question is, what is the distinction between non-current investments and long-term investments? Please understand very carefully. Non-current investments are those investments, I repeat, non-current investments are those investments which are expected to be realized, after 12 months from the balance sheet date. I repeat, non-current investments are those investments which are expected to be realized after 12 months from the balance sheet date, On the other hand, long-term investments are those investments which are expected to be realized after 12 months from the acquisition date, So what is the triggering point? The triggering point here is balance sheet date or the acquisition date. Listen once again. Non-current investments are those investments which are expected to be realized after 12 months from the balance sheet date, whereas long-term investments are those investments which are expected to be realized after 12 months from the acquisition date. And that is why a discrepancy may arise in the presentation of financial statements. So what is the requirement? The requirement is guidance note on Schedule 3 says that though Schedule 3 clarifies that the accounting standards would prevail over itself in case of any inconsistency between the two, but we also need to remember that AS 13 does not lay down the presentation norms, though it requires disclosures to be made for current and long-term investments. So AS 13 is not dealing with the presentation, Schedule 3 is dealing with the presentation. So we need to harmonize both. Hence, what the guidance note says, the portion of long-term investments as per AS 13, which is expected to be realized within 12 months from the balance sheet date, needs to be shown as current investments under Schedule 3. Are you getting my point? So that is the thing which we need to reconcile. There could be certain portion within the long-term investment that is expected to be realized within 12 months from the reporting date. So that will be a current portion of long-term investments. So whatever current portion of long-term investment is there, that needs to be separately disclosed in your financial statements. I believe this point is clear to each one of you. There's a question in Q&A. Let me see this question. In what conditions do we have trade receivables as non-current? There is a question from Sumer Singh ji. Sumer Singh ji, there can be many examples. Like one example is the trade receivables are getting delayed because the customer is going into CIRP, that is Corporate Insolvency Resolution Process. So when the customer went into CIRP, what happened? The payment was stopped by the insolvency professional and you are not expecting this payment to be realized in next 12 months. In that very case, what will happen? Your trade receivables become non-current. Am I clear, Sumer Singh ji? So I believe the point is clear. Okay. Let me proceed further. I believe the audience must have understood this distinction of non-current and long-term. If you have any queries, you're most welcome to ask. Meanwhile, I'm proceeding further. See here. In one case, deferred tax liability was classified into current and non-current category. In another case, deferred tax asset was classified into current and non-current category. It's a typo error. It is a non-current category. So what happened? Basically, deferred tax asset or liability was classified into current and non-current category. The question is, can deferred tax asset or deferred tax liability, as the case may be, categorized into current and non-current category? Yes or no? Yes or no? Let me make the correction meanwhile. What is the answer? Let me see the chat box. It is always non-current, only non-current, always non-current. Yes, correct answers are there. So as per the guidance note on Schedule 3 and as per Ind AS 1. So if you are following accounting standards, then accounting standards are silent. Guidance note is clarified. But if you're referring Ind AS, then Ind AS 1 specifically has given a situation that deferred tax asset or deferred tax liability, as the case may be, will always be non-current and they cannot be classified as current item. So what is written here? Guidance note states that with regard to presentation and classification of net deferred tax asset or liability, the same should always be classified as non-current. They cannot go into current category. Always it is non-current. See this one and tell me the mistake. In one case, there was unpaid amount towards shares subscribed by subscribers of MOA. The company hence gave a descriptive note for the same without any treatment in the financial statements. What is the mistake here? Let me frame a question for you. Perhaps this question will be helpful. Just give me a moment. I'm typing something on screen as a question. Please try to respond this question. This is a question for you. Let us assume there's a company, RST Private Limited. Give me a moment. I'm asking a very interesting question, and let's see how many people will be able to answer. So company is RST Private Limited, and it was incorporated on, say, 26th December 2022. I'm taking a hypothetical situation. The subscribers undertook that they will bring subscription money of rupees 5 lakhs towards such incorporation. Assume that number one, assume that such money was not brought in on 31st March 2022. What will be presented in balance sheet? Number second, such money remained receivable even as on the date of approval of financial statements and the date of audit report. So let me put the dates here. July 28th, 2023. And date of audit report, let me assume, is August 11th, 2023. The question is, what audit considerations will be applicable for above two situations? Yes, any answer now? So let me see the chat box. Separate disclosure in balance sheet. It is March 23, I believe. Then auditor to qualified maybe and adjusting event. Okay. Yeah, you're correct. It's a typo error. It must be March 23. Yes, ladies and gentlemen, any answer? So first of all, let me ask you a question this way. The company was incorporated on 26 December 2022. Please tell me, for this company, RST Private Limited, which is a freshly incorporated company, what will be the financial year? What will be the financial year? I'm getting answer like calls unpaid, calls in arrears. This is not calls in arrears because subscription money cannot be called as call money. The financial year here will be, I got some wrong answers also. The right answer is financial year shall be 31st March 23. Financial year cannot be 31st March 24. Financial March would had been 31st March 24 only when the company would had been incorporated on or after 1st January 2023. Are you getting my point? So in this case, the financial year is ending on 31st March 23. Am I clear till this level? So if any one of you is of the belief that financial year will be ending on 31st March 24, this is a wrong belief. The right answer is financial year shall be ending on 31st March 23 only because the company was incorporated prior to 1st January 23. Up till this level, are you with me? Yes or no? Now, second question is, as on 31st March 2023, the money was not received from the subscribers. So if the money is not received from the subscribers, if I see the answers, G. Pavan Kumar ji says the financials shall also present the receivable from the shareholders. Then I have one more answer from Shriman ji. Capital should be for full 5 lakhs. Okay. Then Charan Kumar ji says if collection is certain. Okay. So primarily, one thing is very much at consensus. The listeners may agree that we have to show this rupees 5 lakh is receivable in balance sheet, and that too as a current asset. So I will pass a journal entry. Tell me the complete journal entry. I will start with the first pointer. The first pointer is journal entry is subscription money receivable account debit. I can type for you on the screen. The journal entry could be subscription money. Sorry for the spelling error. Subscription money receivable account debit rupees 5 lakhs. What shall be this two? What shall we write here? Subscriber name. If I will write subscriber name here, then it will become a liability towards subscriber. Yes, the correct answer is share capital, not share application money. Please understand, a participant replied share application. It cannot be share application money because nobody is applying for the shares. We need to make a distinction between share applications and subscription money. So I am not applying for the shares in the company. Rather, I am the kind of first shareholder and a subscriber. So here what will happen? It will be paid up share capital. Rupees 5 lakh. Please take a note. Please take a note. This kind of capital is also called as deemed capital by virtue of section 2, clause number 64. Please take a note of this section. Section number 2, clause number 64 says this kind of subscription money receivable is a deemed share capital as a paid up share capital. So you will credit the paid up share capital account. So one thing is certain, as on 31st March 23, the journal entry will be subscription money receivable account debit to paid up share capital account. Subscription money receivable will be shown below the heading current asset, and paid up share capital will be shown on the equity and liability side. There is a question from Parasmalji. Can't we show receivable from subscriber and putting their name? Parasmalji, we have to show this thing, but in notes to counts. I'm talking about balance sheet. So in balance sheet, you cannot show the name of subscribers. No? You have to show subscription money receivable. Then in notes to counts, when you will disclose related party disclosures, there you will write subscription money receivable from Mr. X, Mr. Y subscribers. Am I clear, Parasmalji? So now other question arises. Now we have resolved query number 1. Query number one was that such money shall be presented in the balance sheet as subscription money receivable on one hand and paid up share capital on the other hand. Now let us travel a beyond way. Beyond way the travel is, let us assume the financial statements were approved on 28th July 23 and the audit report was signed on August 11, 23. Now as an auditor, what repercussions you need to consider? What repercussions you need to consider? I got one answer from Shriman ji. INC 20 not filed within 180 days seems to be business not commenced as per the Companies Act. Shriman ji, your answer is quite close to the correct answer, but can you conclude your answer? INC 20 is not filed, that I agree. So how this audit report will be concluded to this point? For this point, what will be the conclusion of auditor? Yes, going concern. So what you need to remember, please take a note. Please take a note. The note is section 10 capital A and section 248 1D. Now, what is happening over here? Section 10 capital A of company that says that the subscribers need to bring in subscription money within 180 days of company's incorporation. If you see this question, the subscribers have failed to bring in the subscription money within 180 days of company's incorporation. Now, because subscribers have failed to bring in the subscription money within 180 days of company's incorporation, what will happen? The ROC's power to strike off the name of company will be invoked by virtue of section number 248 subsection 1 clause D. Section 248 subsection 1 clause D of the Companies Act says that if section 10A is not complied with by the subscribers, then after issuing or after providing opportunity of being heard, the ROC may strike off the name of company from its records. That means if 10A is contravened for bringing in the subscription money, the company's name can be struck off from ROC records, and obviously ROC will provide you opportunity of being heard prior to that. It means that as an auditor, when I will be signing my audit report on 11th August 23, I will put up a paragraph in my audit report. The heading of that paragraph will be material uncertainty about going concern. Are you getting my point? So in my audit report, I will be putting up a paragraph, material uncertainty about going concern. And that's the way we have to conclude our report. Am I clear? Any question on this front? So because ROC power may be invoked, in that very sense, what will happen? I'm not sure whether ROC will strike off or not. So material uncertainty is arising about striking off, and that's going concern assumption may be impaired, and that we need to report in our audit report. There is a question from Rajendra ji. Under which head subscription money receivable will be shown in the balance sheet? It will be going in the main heading current assets and then other current assets. Am I clear, Rajendra ji? Other current assets. Below the other current assets, you will write subscription money receivable. Then there's a question of Vishali Desai ji. Will it be a qualified report? Vishali ji, I will not say it is a qualified report. Reason being, if you refer SA 705, you can take a note. SA 705 read with SA 570. SA 705 is modifications in audit report and SA 570 is going concern. What they say, when material uncertainty about going concern is there, but going concern assumption is quite okay, then you will not qualify, rather you will give a separate paragraph about material uncertainty for going concern. Then there's a question from G. Pavan Kumar ji. What happens if management has initiated the business, however not received the subscription amount? So G. Pavan Kumar ji, in this very case, again, section 248 will be invoked because ROC will not automatically strike off. No, he will give you opportunity of being heard. In that very sense, what will happen? Let us assume ROC served you a notice that I am going to strike off the company, show cause why I should not strike off. Then what you will say? You will say, please condone the delay of bringing in this money. I will bring in the money. So you will go for compounding of offense also. So you will go for compounding of offense. You will bring in the subscription money. And then obviously you can carry on the business. Otherwise, ROC will strike off. Am I clear, sir? Pavan Kumar ji. Then there's a question from Avinash ji. What about going concern assertions if this got fulfilled but ROC had issued notice? So that is why, Avinash ji, I replied to G. Pavan Kumar ji also. Even if other assertions about going concern are fulfilled, still you have to consider the ROC notice. And then you have to consider the steps you are going to take to mitigate the notice issued by ROC. What can be the mitigation steps? To request the ROC for compounding of offense, number one. Number second is to request the ROC to condone the delay. So for compounding, we have section number 441. For condonation, we have section number 460. For levying the penalty, we have section number 454. So if you will be complying these three sections, then ROC may say that, okay, I will allow you to continue. In that very sense, the going concern assumption will remain appropriate, subject to your reporting in the audit report about material uncertainty. Please remember, difference is there between inappropriateness of going concern assumption and material uncertainty about going concern assumption. What I am discussing is not inappropriateness, but material uncertainty. Am I clear, Avinash ji? Let me see something in Q&A also. Chandrasekhar ji, what should I repeat? Can you please help me? Because I have stated so many things. Then there is a question from some anonymous attendee. In this second case also, we'll pass the entry and mention this as current asset or non-current. Obviously, it will be current always, because by virtue of company law, it is the obligation of the subscribers to bring in the money. So it will always remain current. Am I clear? Okay, now there is a question from P.N. Rajshekhar ji. If a part amount is bought in by the shareholder, so in this very case, sir, what will happen? Section 10A still will be involved. Section 10A still will be involved because you have to bring in the full amount. Only thing is, whatever amount you have brought in, that will be having a reversal entry, bank account debit to subscription money receivable account. Otherwise, things will remain same, because Section 10A has given no exemption to bring in the part amount or the 50% amount. Am I clear, sir? Yes, you have to qualify, but that qualification is not a pure qualification. I repeat, that qualification, Pankaj Kumar ji, is not a pure qualification. That is a kind of partial qualification, because you have to give a separate heading, material uncertainty about going concern. So I will request the house to download SA 570 and take a note, material uncertainty about going concern. See that paragraph. In SA 570, Institute of Chartered Accountants of India has given the guidance how to report about material uncertainty for going concern. Automatically, you'll get to understand what is the difference between material uncertainty and inappropriateness. Shall I proceed, Pankaj ji? Ashish ji, there is a question by Ashish ji. Is it emphasis of matter paragraph referring to notes in financials in this case? It can be emphasis of matter paragraph also, but to emphasize, you have to put in the mitigation factors. So if management will put in the mitigation factors in notes to accounts, obviously, then instead of giving the material uncertainty paragraph, you can give the emphasis of matter paragraph. So I will be proceeding further. Otherwise, this whole question will take away the entire time. So I believe this point is clear. And that was the mistake which people were committing. So if I go back, this is the scenario. Section 2, clause 64, I discussed. Section 10, capital I also discussed. So in that very case, what was the requirement? Section 2, clause 64 and Section 10A of the Companies Act 2013, read with the guidance note, requires that unpaid amount towards this year subscribed by subscribers or the memorandum of association should be considered as subscribed and paid up capital in the balance sheet, and the debts due from the subscriber should be appropriately disclosed as an asset in the balance sheet. Now, what is that asset? Other current assets. That I already discussed with the help of this illustration. Now see this one and tell me what is the mistake here. In one case, a reconciliation of number of shares outstanding at the beginning and at the end of the reporting period was given. The company, however, gave such reconciliation for total number of shares in aggregate, whereas the notes also stated that company has issued equity shares as well as preference shares. I believe this discrepancy is self-evident. Still, what is your take? What is the mistake here? So we generally give a note in the notes, opening balance plus minus movements during the year is equal to closing balance. So this was given in totality rather than giving the breakup of equity and preference shares. That is a mistake. So what is the mistake? The mistake is that you have to segregate equity shares and preference shares because both are different classes. So what is the requirement? Guidance note states that you have to make disclosure relevant for understanding of the company's share capital. The reconciliation is to be given for even for the amount of share capital. So not only the number of shares, you have to give the amount also. The guidance note requires that it should be disclosed separately for both equity and preference shares, and reconciliation for comparative previous period is also required to be given. So you replied for point number B only. Two more things which we need to understand is not only the number of shares need to be reconciled, but their face value also need to be reconciled. And plus other requirement is not only current year data needs to be given, but also reconciliation is required to be given for previous comparative period as well. I believe this point is clear to each one of you. So in real world, this amount portion was missing. Comparative was also missing. See this one and tell me the mistake. In one case, shares in the company held by each shareholder holding more than 5% shares was given by specifying the number of shares held. The company, however, gave such shareholding for total number of shares in aggregate, whereas the notes also stated that company has issued equity shares as well as preference shares. So it is again self-explanatory, because quite similar to the previous clip, we have to give the 5% criteria for both equity shares as well as preference shares, and that too with the comparatives. So I'm skipping this one because it is quite similar to the previous discussion. See this one and tell me very carefully. In one case, the loan payable by the company was converted into equity under an arrangement between the company and the lender. The company disclosed the same as shares allotted as fully paid up pursuant to the contracts without payment being received in cash. So for your reference, let me tell you, clause 1 of note 6A of part 1 of schedule 3 requires separate disclosures for non-cash allotments. So what the company did, company converted loan payable into equity share capital and disclosed the same as shares allotted for consideration other than cash. Is the company correct? So if the loan payable is converted into equity share capital, can we say that shares have been allotted for consideration other than cash? Is it correct? So company is wrong here. Actually, when loan is converted into equity, the cash was already received. No. When loan was received by the company, what was the journal entry? The journal entry was cash account debit to loan payable account. And when this loan payable is converted into equity, what is the journal entry? Loan payable account debit to equity account. It means that the company is wrong. So what is the correct scenario? The correct scenario is the guidance note requires that such an allotment is considered as shares allotted for payment being received in cash and not as without payment being received in cash. And accordingly, same is not required to be disclosed as per this very note 6A. So it is quite explanatory in a self sense only. Consider this one and tell me the mistake. In one case, the company made a separate disclosure of shareholding of its promoters, including the percentage change during the year. The company disclosed the same in the format prescribed under Schedule 3, which requires disclosure only in respect of shares held at the end of year. What is the mistake here? Yes, any idea? Let me see what is the answer. Percentage change, okay. So quite a correct answer now. Let me show you the correct scenario. The guidance note requires that the company should also disclose the number and percentage of shares at the beginning of the year. So comparative is also required as additional columns in order to facilitate an understanding of the percentage change during the year. So if you need to give the percentage change, along with the percentage change, you have to give the comparative year also. See this one, next clip, and tell me the mistake. In one case, the company received calls in advance from some of the shareholders, and the company disclosed the same as part of paid up share capital. So calls in advance were received, and the company disclosed the same as paid up share capital. For your reference, let me take you to section 50. Section 50 of the Company Act says that a company, if so authorized by articles, may accept from any member the whole or a part of amount remaining unpaid on any shares held by him, although no part of that amount has been called up. So question arises, if you have received calls in advance, can it be shown as a part of paid up share capital? So when you will receive calls in advance, what the journal entry will pass? Bank account debit 2. Now this 2 could be share capital. Can we consider it as share capital? Answer is no. It is a liability only. It is a liability only. We cannot call it as share capital. And for this purpose, we have a MCA circular also. Let's see. MCA circular of year 1961 clarifies this situation, and it was stated in that very circular. That time it was a DCA, Department of Company Affairs. Now it is MCA, and the circular clarified that calls paid in advance are to be reflected under other current liabilities. So you cannot call it as a share capital. Even otherwise, if you refer section number 2, clause number 64, section number 2, clause number 64 defines share capital as paid up share capital, and that is not including this calls in advance as a part of paid up capital. So what is the scenario? Scenario is calls received in advance cannot be called as paid up share capital. It will be reflected under the heading other current liabilities. See other one. In one case, the company was having long-term borrowings. The company nowhere separately disclosed the current maturities of such long-term borrowings. What is the mistake here? This question is also relevant because on this current maturities of long-term borrowings, the Schedule 3 was amended. So year 21-22 was the first year when we applied revised schedule 3 post amendment. So what is the mistake here? So one answer is, in that case, the entire loan will be short-term borrowing. Okay. Has to be shown in, okay. Has to be shown under short-term current maturity. It has to be disclosed separately, current maturities. Okay. So mixed responses are there. So to overcome the mixed responses, just see the correct scenario. So till 31st March 21, because this is a scenario prior to amendment, till 31st March 21, the current maturities of all long-term borrowings were required to be disclosed under current liabilities, other current liabilities. So when Schedule 3 was not amended, what was the requirement? Current maturities of long-term borrowings were required to be disclosed below the heading other current liabilities. But Schedule 3 was amended of late. And from 1st April 2021, the requirement is the current liabilities of all long-term borrowings. The current maturities of all long-term borrowings will be disclosed under short-term borrowings and not under other current liabilities. So now the shifting has taken place. Earlier it was below other current liabilities. Now it has been shifted to short-term borrowings. So that is a change because of Schedule 3. See this one and tell me the mistake. In one case, the company was having secured long-term borrowings. In one case, the company was having secured long-term borrowings. The company disclosed that all long-term borrowings are secured. All long-term borrowings are secured against tangible assets owned by the company. And I emphasize personal security of promoters, shareholders, and third parties. Yes, any mistake over here? For your help, let me emphasize there are two limbs. There are two cases here. One is borrowings are secured against tangible assets owned by the company. And second one is personal security of promoters, shareholders, and third parties. What is the mistake here? Let me see. No personal security in companies to give details of tangible assets given as security. Okay. Think once again, because your answers are very quick answers. These are not very much a thoughtful answer. Security and guarantee to be given separately. Company cannot have personal security of third parties. No, company can have, in fact. Third party should not be. Okay. So let me spill the beans and see the correct answer. So we have to refer the guidance note on Schedule 3, and it requires that a blanket disclosure will not suffice, and hence the nature of security shall also be specified separately in each case. So what they are writing, all. What they are writing, let me highlight for you with a pointer. They're highlighting all. This all long-term borrowings is not good to be disclosed. What you have to do, you have to disclose separately for each case the nature of security. Further, the nature of security should also cover the type of asset given as security, for example, inventories, PPE, intangibles, etc. More importantly, when promoters, shareholders, or third party gives any personal security for any borrowing, such as shares or other assets held by them, disclosure should be made thereof, though such security does not result in classifying such borrowing as secured. So when a promoter or a director or relative of a director gives us personal guarantee or a security for the loan taken by a company, that loan is not becoming a secured loan, although it is a collateralized loan. So for this kind of loan, you cannot call it a secured loan, but in notes to accounts, you will separately tell the users that this loan is having collateralized by promoters, shareholders, or third party by virtue of their personal security, etc. I believe this point is clear to each one of you. Obviously, contingent liability needs to be shown. That is a different game altogether. But yes, disclosure cannot be called as a secured loan whenever third party gives any kind of guarantee. There is a comment by Vipin Bansali, violation of deposit rules. So Vipin ji, you have to tell me what kind of violation you foresee about deposit rules. Because when a company is having a loan payable, and if the company takes security or a guarantee, then it cannot be called a deposit, because to call an amount as a deposit, you must receive something. Security being given by a third party is not a receipt of a loan or a liability, and hence it will not be within the purview of deposit rules. Anyway, see this other clip and tell me the mistake. In one case, the company was having some leasehold improvements. The company disclosed the leasehold improvements by clubbing the same under assets held under lease. What is the mistake here? What is the requirement to disclose leasehold improvements? Yes, any answer? No answer? So see the correct one. Let me see, somebody replied. Shobna Shekharji has replied, part of PPE. Charan Kumarji has replied, separate PPE. Okay. Let us evaluate ourselves. See this correct scenario. Guidance note says that leasehold improvement should be shown as a separate asset class. So I got the correct answers also and wrong answer also. So it is a part of PPE, but at a separate class. So leasehold improvement is a other class of the property, plant and equipment. There's a question from Bharat Kumarji. Is rounding off mandatory, or we can disclose full figures without decimal for a company having turnover of less than 100 crores? Bharat Kumarji, rounding off is mandatory. There is no exemption from rounding off as far as Schedule 3 is concerned. So big company, small company, large turnover, huge turnover, no turnover, you have to round it off. That is mandatory. And rounding off slabs are given in Schedule 3 itself. Anyway, see this one. In one case, the company was having some investments in LLPs. The company disclosed the same under the subheading investments in partnership firm. So for your reference, Schedule 3 requires disclosure in regard to investments in capital of partnership firms, the name of the firms with the names of all their partners, total capital and shares of each partner. So what is the discrepancy here? So if a company invested in capital of LLP and is disclosing the same below the heading investment in partnership firm, what is the discrepancy here? Any answer? Okay, think logically, can you call LLP as partnership firm? That I got one answer from Prasanna ji, investment in body corporate. Okay. So let me spill the beans again and check out. Guidance note states that LLP is a body corporate and not a partnership firm as per the Partnership Act. Hence, disclosures pertaining to investments in partnership firm will not include investments in LLPs. The investments in LLPs will be disclosed separately under other investments, will be disclosed under separately. The heading is other investments. So you cannot call LLP as a partnership firm. So, and you know, I must reiterate, all these non-compliances which you are observing here have been taken from real world annual reports, and that to Indian corporates. Proceeding further. See here and tell me what is the mistake. In some cases, the company has given capital advances for procurement of PPE. This is one of the very prominent mistake people are committing. So I repeat here, in some cases, the company has given capital advances for procurement of property, plant and equipment. One company disclosed the same under the subheading capital work in progress. Another company disclosed the same as short-term advance as PPE was expected to be received in next months from the reporting date. So what is the correct disclosure? How should we disclose this kind of capital advance? I got from one answer from Jagdish ji, to be disclosed under long-term advances. Okay. Any other participant? Long-term loans and advances. Okay. Long-term advance. So all three have replied long-term. Long-term. One has replied current. So let me show you the correct one. Shobna ji, you're right. Sohil ji. Okay. I think Sohil ji, you have given a typo error. Well, your reason is correct, but the answer is getting incorrect. So Charan Kumar ji, your answer is getting incorrect. So let me show the correct answers. So we have to refer to the guidance note and just see how the things are propelling. Capital advances are shown separately. Capital advances are shown separately under the heading long-term loans and advances and are not classified as capital work in progress. So first of the prominent mistake is people have classified these capital advances under the capital work in progress. These are not capital work in progress. These are rather long-term loans and advances. More importantly, the guidance note states that typically companies do not expect to realize capital advances in cash. So you are not going to get the refund of the advance. No. Rather, it will be adjusted against the PPE or intangible assets. So what the guidance note says, rather over the period, these get converted into PPE and intangible assets, which by nature are non-current assets. Hence, the guidance note states the capital advances should be treated as non-current assets, irrespective of when such assets are expected to be received, and should not be classified as short-term or current. So primarily two takeaways are there. Capital advances vis-a-vis the property, plant and equipment or intangible assets are classifiable as non-current assets. And second one is they cannot be shown below the heading capital work in progress. They will be shown under long-term loans and advances only. So see other one. Tell me the mistake here. Okay, so now some practical world questions I'm asking. So to set the background is we have a conflict between the requirements of Accounting Standard 3 or Ind AS 7 and Schedule 3. So just see what Accounting Standard 3 says. Accounting Standard 3 says deposits with original maturity of 3 months or less only should be classified as cash equivalents. So what follows is, as per AS3, bank balances held as margin money or security against borrowings are neither in the nature of demand deposits nor readily available for use by company, and accordingly do not meet the aforesaid definition of cash equivalents. But if you refer Schedule 3, what is happening under Schedule 3? Schedule 3 says cash and cash equivalents comprise of balances with banks held as margin money or security against borrowings, guarantees, etc., and bank deposits with more than 12 months maturity. So AS3 is saying that those balances with banks which are held as margin money or bank deposits with more than 12 months maturity cannot be classified as cash and cash equivalent. On the other hand, Schedule 3 says that such kind of bank balances and bank deposits can be classified as cash and cash equivalent. So there is a kind of apparent conflict. Now the question is how to resolve this conflict. How to resolve this conflict? Any answer? So if you see AS3 says something and Schedule 3 says entirely a different thing, how to resolve this conflict? So Prasanna ji has given the answer: in case the maturity is more than 12 months, it should be shown separately. No, wrong answer, sir. Jagdish ji says these are like restricted cash and not readily available. Again, wrong answer, sir. One answer is AS will prevail. Okay, quite a correct answer, Muskan ji. AS will prevail over guidance note. I will not say AS will prevail over guidance note. Guidance note need to be read harmoniously because AS is not dealing with the presentation part only, you know. So just see what guidance note resolved. Basic question which I asked was how to deal with this apparent conflict between the requirements of Schedule 3 and accounting standards with respect to items that should form the part of cash and cash equivalents. So the guidance note resolved this conflict, and what it stated, AS would prevail over the Schedule 3. Company hence need to make necessary modifications in the financial statements. Accordingly, the conflict should be resolved by changing the caption cash and cash equivalents to cash and bank balances. And then cash and bank balances will have two subheadings. Number one, cash and cash equivalents, and number second is other bank balances. The former means this cash and cash equivalent. The former should include only the items that constitute cash and cash equivalents defined as per AS3 and not as per Schedule 3, while the remaining line items will be included in the letter heading. So whatever AS3 says will go here, and whatever Schedule 3 says will go here. That kind of conflict we can resolve by this way. See this one. Share application money. For share application money, I'm giving you one question over here. See this question. Now I will give you exactly 1 minute to answer my question. So the facts are, the company is RST Private Limited, and from equity and liability side, we came to know that company received share application money on 15th January 2021. The money was received through normal banking channels, but this money is pending allotment. This money is pending allotment since 15th January 2021. It remained pending allotment as on 31st March 21, and it remained pending allotment even continuously till 31st March 22. So my question to you people is, what are the repercussions? What are the repercussions we need to consider as auditors or as practicemen, as the case may be? Yes, any answer? I will give you exactly 1 minute. Sohil ji, you have given the answer. Shares have to be allotted within 180 days. This 180 days is wrong. Vaswana ji has given the answer, deemed deposit. Okay. Jagdish ji has given the answer, non-compliance to Companies Act. Allotment should be, then Shriman ji has given the answer, allotment should be made within 60 days, otherwise repay or treat as deposit. Okay. The money has to be repatriated. Parasmal ji, okay. So let me put the question in two stances. One is, what is the requirement that auditors need to follow with respect to their audit report? because whatever answers you are giving me are quite close to the right answers, because it will be taken as deemed deposit. So if you are the auditor for the financial year ending on 31st March 2022, then what you will consider as an auditor? Yes, any answer? What you will consider as an auditor? Yes, any answer? For 31st March 21, it is not deposit. Okay, I can take this thing. Dinesh ji says disclose the deemed deposit in Caro. For 31st March 22, it is deposit. Okay, so first of all, let us understand what the law says, and then we will get to know some more details. Surprisingly, each one of us is very much aware about Caro, and we are answering as per Caro also. To that extent, you are right. But one thing still is missing. That one thing I will come in a while, but let me discuss what Caro says and what company law says. So let me go back, just see what happens. So for the share application money, we have to refer to sections primarily. One is section number 42 and second one is section number 73 for deposits. So what the law says, a company making share application money shall allot its securities within 60 days from the date of receipt of application money. So it is not 180 days, it is 60 days. If the company is not able to allot the securities within that period, it shall repay the application money to the subscribers within 15 days from the date of completion of 60 days. Then section number 42 subsection 6 additionally states that if the company fails to repay the application money within the aforesaid period, it shall be liable to repay the money with interest at 12% per annum from the expiry of 60th day. So please take a note. The very moment the company defaulted in repayment of share application money, the interest at 12% per annum needs to be provided for in the books of accounts. For this purpose, we have to provide the interest at 12% per annum in compliance of section 42(6) read with AS 29 or Ind AS 37. So as an auditor, we have to check whether AS 29 or Ind AS 37 has been complied or not to provide for the interest at 12% per annum. Now, moving ahead, if you refer section 73 of the Companies Act with Rule 21C7 of Companies Acceptance of Deposit Rules, what this rule says, if the securities for which application money or advance for such securities was received cannot be allotted within 60 days from the date of receipt of application money, and such application money is not refunded to the subscribers within 15 days from the date of completion of 60 days, such amount shall be treated as deposit. It is popularly called as deemed deposit. So ultimately what is happening, the money has become deemed deposit, and this deemed deposit means that this money was received by you in contravention of section number 73. So for that purpose, what will happen, you have to report appropriately in Caro. If you go to Caro, what Caro says in para 3.5 and para 3.16, sorry 14, para 3.5 says, in case the company has accepted deposits, whether the directives issued by Reserve Bank of India and the provisions of section 73, etc., have been complied with or not. So in para number 3.5, you will report that company has accepted this deemed deposit in contravention of section number 73. In para 3 number 14, you have to report whether section number 42 was complied with or not, because who knows that the share application money was received as a matter of private placement or preferential allotment. So if applicable upon you in respect of share application money meant for private placement or preferential allotment, you additionally need to report under para number 3, subpara number 14. Now, to that extent, you were absolutely right in your answers. To that extent, you were absolutely right in your answers that you have to report under Caro regarding this deemed deposit. One thing you missed was provision for interest payable at 12% per annum. So that is also covered now. So AS 29 or Ind AS 37 needs to be complied with. Please put up a kind of extra effort and tell me, with respect to share application money in this very question, anything else is also getting reportable in your audit report or not? Anything else is also getting reportable in your audit report or not for the year ending on 31st March 22? I'm giving you 30 seconds, think and reply me back. Anything else is getting reportable or not? Yes or no? Any answer? I can give you the hint, but I have a request also. When I will give the hint, please don't search on Google. The hint is section number 164, subsection 2, clause B. Section number 164, subsection 2, clause number B of the Companies Act 2013 regarding disqualification of directors. Yes, any answer now? Yes, any answer now? No answer? I again repeat, the hint is disqualification of directors under section number 164, subsection 2, clause B. Qualification shares, no. Call unpaid money, no. Director will be held responsible, non-compoundable offense. Deepika ji, director will be held responsible, that is okay, but I'm asking about the audit report requirement. Shripat ji, this we have already covered. Deposits and interest should be paid, so we have to report accordingly in the audit report. This I already discussed, but one very big thing is still missing. One very big thing is still missing about director's disqualification. Can you see any director's disqualification in this question? Can you see any director's disqualification in this question? And you know, this is a real world case. Okay, I'm displaying the provision. I want that you should read this provision and then reply. Otherwise, I have to reply. But I will ask you and request you as well to make an effort to answer the disqualification of directors by reading out this provision. The provision is, so if you refer section number 164 subsection 2, section number 164 subsection 2 says that I am writing this 164 to the layman only, not word by word. Any company other than the government company which has made default in filing of annual financial statements or annual returns for 3 continuous financial years, or has made a default in repayment of deposits or interest thereon, debentures or interest thereon, or dividend for more than equal to 1 year from due date, then directors of such company cannot be reappointed as directors of such company or appointed in other company for next 5 years. Now, having a look out on this very provision, can you please tell me whether in my given question, any disqualification is arising or not? Answer is yes. In my question, the disqualification is arising under section number 164 subsection 2 clause B. This is clause B. It became a deemed deposit. And what happened? The due date has passed for more than equal to 1 year. And that's why disqualification has taken place vis-a-vis the directors. And you must understand, for this kind of disqualification, no separate resolution is required to be passed for removal of directors. It is a kind of automatic vacation from the office. And you must be aware, please take a note. We have section number 143, subsection 3, clause G. I repeat, we have section number 143, subsection 3, clause G. Section number 143, subsection 3, clause G says that auditors have to report. I repeat, auditors have to report whether or not the directors were disqualified as on balance sheet date under section 164 subsection 2 of the Companies Act. In my given question, the auditors of RST Private Limited have to report that directors are disqualified as on 31st March 2022 because they have failed in refunding this deemed deposit for more than equal to 1 year. Am I clear? Is this question clear to each one of you? So this is one of the very prominent mistake that I have observed in the financial statements of some of the corporates. On this issue, if you have any question, you're most welcome to ask. So please be very careful when you report on this front, because this kind of issue may come up in real world also. There's a question from Sohilji. In one case, the share application money has come from a non-resident and shares are allotted as per offer price. However, extra money has come in because of exchange fluctuation. What to do in this situation? And the company has repaid the amount. So in this very case, whatever extra money came in, you have to refund this amount. And for refunding of this amount will be deemed as capital account transaction. And for this purpose, you have to take the permission from RBI. So for this purpose, you have to refer FDI regulations, and in FDI regulations through authorized dealer, you have to refund this amount. But yes, RBI permission is required. So there is no contravention as such because of exchange fluctuation. If extra money came in, that is normal practice. But you have to take the help of authorized dealer to move in the application to RBI. And yes, I must tell you one more thing, Sohilji. If this kind of extra money is coming up, you have to disclose about this thing in notes to accounts so that the readers must understand that this extra money is because of some fluctuation. An application is pending before authorized dealer. Any other question? Shall I proceed otherwise? Okay. See this one. So now balance sheet we discussed. Let us discuss P&L items also. So in one case, the company was engaged in manufacturing of cars and has made sale of scrap, which was generated during the manufacturing process. The company disclosed this sale of scrap as other non-operating income. So sale of scrap was disclosed as other non-operating income. Is there any mistake here? So Shobna ji replied, should be other operating income. Okay. Any other answer? Any other participant? Okay, let me disclose the right answer. Shobna ji, you're right, in fact. So guidance note says that sale of manufacturing scrap states that the sale of manufacturing scrap arising from operations from a manufacturing company should be treated as other operating revenue, since the same arises on account of company's main operating activity. So you will not call it as other non-operating income, rather it will be classified as other operating revenue only. See this one. In one case, the company was having interest from customers on amounts overdue. The company has disclosed the same as other operating revenue. Is there any mistake here? Is there any mistake here? So interest overdue, whether it is other operating revenue. So yes, correct answers are there. So the same answer I must display here as well. The guidance note says that this kind of interest income for a company other than a finance company should be disclosed under the heading other income. Please note the words other than finance company. Had this been a finance company, it will go to other operating revenue. Otherwise, it is other income only. Now, see this one. In one case, certain penalties were levied upon the company under the PF law. The company has disclosed the same under employee benefit expenses as contributions to Provident Fund. Any mistake over here? There is a question. Before I resolve the question, let me see the chat box. There should be other expenses, rates and taxes should be disclosed. Okay, I can take this as correct answer, because at least one thing is certain, that these cannot be called as employee benefit expenses. So where they will go? The C guidance note states that the penalties and other similar amounts paid to statutory authorities are not strictly in the nature of contribution and should not be disclosed here. So where they will go? They will either go to rates and taxes, or maybe will go to other expenses, as the case may be. There is a question from somebody in Q&A. Chandrasekhar ji has asked a question. A private limited company has purchased an asset from a company outside India in which one of the director of Indian company holds majority shares. The Indian company has not settled the liability for more than 1 year. Does it amount to deemed deposit and directors will be disqualified? So Chandrasekhar ji, the facts are incomplete. I presume that whatever asset was purchased under an agreement. If the asset was purchased under an agreement, in that very case, this may not be called as a deemed deposit, because Rule 2 has given a specific exemption to this kind of purchase. So you have to refer the contractual arrangement. Depending upon the contractual arrangement, it may or it may not become a deposit. But primarily, what I feel, it is not a kind of deposit, primarily. Am I clear, Chandrasekhar ji? So you have to see the contract. Depending upon the contract time frame, it may not be a deposit. So what I will suggest now, you have to download Rule 2 of Companies Acceptance and Deposit Rules and do Control F. In Control F, please search about the word property. Automatically, you will get to know whether your amount is becoming deposit or not. But yes, I must say one thing. I must say one thing, Chandrasekhar ji. When you say the company has purchased an asset from a company outside India and the company has not settled the liability, please understand. Please understand. I'm also presuming that you have not, you have not received any advance for that. You have not given any advance for that purpose. Reason being, when you say deposit, no, to classify any liability as deposit, you must receive something also. You must receive some funds. But in your case, when you purchase the asset, you have received no funds. So the liability is rising on account of trade payable, not or account of contractual liabilities, but not on account of something being given to you as a matter of financial accommodation. Am I clear, Chandrasekhar ji? So unless and until you are receiving any amount, you cannot call it as a deposit, no? Am I clear, Chandrasekhar ji? Okay. So let me proceed further. See this one. In one case, the company has taken certain assets on finance lease and was paying lease rent for the same. The company has disclosed the finance charges on finance leases under the heading miscellaneous expenses. So whatever amount is being paid as finance charges, can we disclose the same under miscellaneous expenses or something else is required? Yes, you have the correct answers, finance costs or interest costs. Correct answers are only given by you. So that is the thing written here also. Guidance note states that the finance charges on finance leases are in the nature of interest expenses and hence should also be classified as interest expense under the heading finance cost. So you have given the correct answers, no problem in that. Next, see this one. In one case, the company has paid some interest on shortfall in payment of advance income tax. The company has clubbed such interest with current tax under the heading tax expense. So normally 234A, B, C interests are being paid. So whatever interest you have paid on shortfall in payment of advance tax, can you club this interest with the item current tax? What is your take? I got the answer as interest should be shown as other expenses, rates and taxes. Okay. Wrong answers, in fact. Harsh, your answer is quite close to the correct answer. Sohil, you are absolutely perfect. So interest is not a part of tax. Interest is not a part of tax. So we are wrong to say that interest is the nature of tax. See, accounting moves on substance over form. So in substance, it is not a tax. It is a kind of finance cost. And that is what guidance note says. Guidance note states that interest on shortfall in payment of advance income tax is in the nature of finance cost and hence should not be clubbed with current tax. The same should be classified as interest expense under the finance cost. However, such amount should be separately disclosed. So people are committing this kind of error in real world. They're clubbing this interest with current tax, which is wrong. It should be considered under the heading finance cost itself. See the next one. In one case, the company has incurred CSR expenditure. The company has disclosed the CSR expenditure under the heading other expenses with a subheading CSR expenditure for the year. So what happened in the P&L account? They made a heading other expenses. Now the description of other expenses was given in notes to accounts. In that description, they have shown CSR expenditure. Is it correct? Can CSR expenditure be disclosed below the heading other expenses? So Harshji says yes, wrong answer. There's a question from Parasmalji, late fees and interest paid in GST, where we need to disclose. So Parasmalji, at least these late fees and interest are not taxes. So late fees will go to rates and taxes and interest will go to finance cost. I believe Parasmalji, your answer is replied. So late fees will go to rates and taxes and interest will go to finance cost. And then there is the answer from Harshji, a separate schedule is required. Harshji, separate schedule is required, but this answer is incomplete, I must say. I will not say it's a wrong answer, but incomplete answer. Then Kodalingam ji, I'm not able to understand what you wish to convey. No part of other expenses or mother expenses or writing. So I think it is a typo error. It is a no part of other expenses. So people have committed a mistake. The mistake is basically CSR expenditure is required to be given a separate line item. So what guidance note says is the expenditure on CSR activities that qualify to be recognized as expense should be recognized as a separate line item as CSR expenditure in this statement of P&L. So on the face of P&L, you have to give a separate line item, CSR expenditure. So you cannot club this up below the heading other expenses. Further, the relevant note should disclose the breakup of various heads of expenses included in the line item CSR expenditure. So what is the requirement? This requirement is a guidance note that CSR expenditure needs to be a separate line item on the face of P&L itself. It cannot be clubbed under the head other expenses. That is prohibited by guidance note. Other expenses is a separate line item. CSR expenditure is separate line item. So if you are preparing P&L on the expense side, you are having, you are having some items like cost of materials consumed. Then you have employee benefits. Then you have finance cost. Then you have other expenses. Now you will be having one more item, CSR expenditure. So separate line item is required. It cannot be clubbed. I believe this is clear to each one of you. Next one. Consider the situation. A company Z has prepared its financial statements for the year ended on 31st March so-and-so. During the year April so-and-so to this March so-and-so, Company Z has issued new equity shares. The company has computed basic earning per share by dividing net profit for the period attributable to the equity shareholders by number of equity shares outstanding at the end of the year. Whether Company Z has computed basic earning per share correctly. To make the thing simple, please tell me whether this rupees 10 basic earning per share here is correct or not. So the company is RST Limited. On 1st April 21, it issued equity. It was having equity shares, 10,000 shares. On 1st October 2021, 1,000 shares were additionally issued. 31st March 2022, the exact outstanding equity shares are 11,000 shares. Let us assume the profit after tax is 1,10,000. So the basic earning per share is 1,10,000 divided by 11,000 equal to 10. So please tell me whether this basic earning per share is correct. What is the correct basic earning per share? Can you please tell me? What is the correct basic earning per share? So one thing is certain, and I'm getting the correct answers for it. You cannot use the outstanding number of shares. When I am Joshiji, your answer is incorrect. It is the wrong BEPS computed. The correct BEPS will be 10.48. Because we have to consider a weighted average number of equity shares and not, we have to consider a weighted average number of equity shares as outstanding rather than actual number of shares outstanding. So just see the correct workings. The correct working is this way. You have to compute a weighted average number of equity shares. Now, what is the meaning of weighted average number of equity shares? 10,000 shares, that is these shares remained outstanding for entire 12 months. 1,000 shares were additionally issued on 1st October. So from 1st October till 31st March, 6 months were there. And that's why time factor is 6 months. This will give you 10,500 number of shares as weighted average number of equity shares. So the corrected BEPS is 10.48. So in real world, what is happening, because we put in the formula in Excel worksheet, and because of that formula, sometimes this kind of mistakes creep in. Please be careful when you have issued shares during the year or when you have bought back shares during the year, then you have to be very careful, because in that very case, the number of shares will undergo a change, because the number of shares will be based upon weighted average number of equity shares on time factor basis. Are you getting my point? I believe this point is clear to each one of you. So please be very careful to compute basic earning per share or diluted earning per share. You have to take only weighted average number of equity shares as outstanding on the balance sheet date. When I say weighted average means you have to compute the average by considering time factor. Time factor example is before you, whereby 1,000 shares were issued on October 1st, 2021. So 6 months was the time factor for that matter. I believe this point is clear to each one of you. Let me see something if there is in chat box. There is a question from Jagdish ji. Question regarding CSR, then why it is not shown separately in part 2nd form of statement of P&L? Jagdish ji, it is shown in part 2nd itself. Only thing is, when we see part 2nd issued by Ministry of Corporate Affairs and notified as such, this P&L statement in part 2nd is not having a separate line item. So Institute of Chartered Accountants of India felt that this kind of absenteeism is a discrepancy in the format, and CSR expenditure otherwise is material. So it is a recommendation of the ICI that the statement of P&L should be suitably amended, and we have to bring in a separate line item to be called as CSR expenditure. Are you getting my point? So what is the scenario here? Part 2nd is untouched. Only thing is, ICI stated that you must show CSR expenditure and a separate line item. And this separate disclosure is in line with the requirements of AS1, or if you say Ind AS 1, on materiality principle basis. Am I clear, Jagdish ji? So whatever I discussed about CSR is the approach that ICAI has inculcated. Separate line item for CSR. Shall I proceed, Jagdish ji? Yeah, it is obviously this principle is adopted by ICAI on materiality basis because guidance note, because schedule 3 is not explicit. So to make the things clear and uniform, Institute says that on the grounds of materiality, it is quite obvious that CSR expenditure influences the users. So it should be shown separately on the face of P&L. Okay, let me proceed further. Something is there in chat box again. Let me check. Yes, clients must be, Jagdish, you're right. Clients must be prescribed. But when we say clients must be prescribed, they must also be prescribed to follow the guidance note, because guidance note is also a part of mandate. So they must follow this thing also. Okay. Now some other observations are also there. Let me discuss these observations with you. Unit of measurement. So it was observed from note regarding related party disclosure. RP means related party. It was observed from the note relating to RP disclosures given in the annual report of a company that amounts of corporate guarantees given on behalf of RPs were disclosed in foreign currencies. It was observed that whereas in the given case, the financial statements have been reported in rupees, certain transactions under RP disclosures have been reported in terms of US dollars, Australian dollars, and Japanese yens. Is there any discrepancy here? What is the discrepancy here? So what is the discrepancy here is that different unit of measurement have been followed. And what is the requirement of the standard? The requirement of standard is you have to follow the single unit of measurement. I repeat, you have to follow the single unit of measurement. So for this purpose, what is the observation? Under Schedule 3, there is an explicit requirement to use the same unit of measurement uniformly throughout the financial statements and notes thereon. Accordingly, such presentation of information is not in line with the requirements of Schedule 3. So you have to disclose even these things in rupees term only. You cannot use different units of measurement. See this one. Very interesting case. In the cash flow statement of an entity, an entity has categorized its cash flows during a particular period into 4 categories, which are cash flow from operating activities, cash flow from investing activities, cash flow from financing activities, and cash flow from other activities. Whether it is appropriate in light of AS3 and Ind 7. Let me tell you what happened. This is a kind of sample cash flow. So let us assume this way: the accountant prepared the cash flow statement, and the net increase in cash and cash equivalents after considering operating activities, investment activities, and financing activities came to rupees 1200. So net increase in cash and cash equivalent was rupees 1200. After that, the accountant computed changes in cash and cash equivalent by comparing opening balance and closing balance, and the net change was 1300. Accountant was worried that this 1200 was not telling me 1300. He tried his level best, but he was not able to reconcile this difference of rupees 100. So what he did, he inculcated and introduced one more line item, cash from other activities. The very moment he introduced one more line item, cash from other activities, it became 100, and this became 1300. This 1300 is now matching with the difference of these two, opening balance and closing balance. So whether this line item, cash from other activities, is the right introduction? Is it right? Answer is no. Answer is no. Why the answer is no? Because under AS3, only 3 cash flows from different activities are permitted. And these different activities are operating activities, investment activities, and financing activities. So you cannot introduce any other item as cash from other activities. So this is a kind of discrepancy. And you would be surprised, this is from real world. People are still committing this mistake. So whenever you see any kind of activity like cash from other activity, it is a red alert, and it is a contravention of accounting standard 3 or Ind 7 as the case may be. So proceeding further, see this one. A company C Limited entered into transactions with various related parties, including KMP and the relatives. In the financial statement, the company has disclosed these transactions by dividing RPs into 3 categories, that is KMP, relatives of KMP, and other related parties. The question is whether related party transactions have been properly disclosed. Any answer? Is there any discrepancy in this disclosure? Yes, any answer? Any discrepancy in this disclosure? Yes, Muskanji, you are absolutely perfect. Describe the other related parties. So when you see these words, na, other related party, it is a kind of ambiguity. And that ambiguity is not permissible because AS 18 says you have to describe the nature and description. So what do you need to do here? The standard requires the entity should disclose a description of the relationship between the parties. In the instant case, C Limited has disclosed a description of relationship only in case of transactions with KMP and the relatives, but has not disclosed the type of relationship in case of transactions with other related parties. Therefore, RPTs in this case have not been properly disclosed. See this one. A company, say company X, is engaged in business of manufacturing and selling of tea. During the previous financial year, it had received subsidy on fertilizers from the government. While preparing the financial statements for the previous year, X has colored the amount of subsidy with revenue of that year. So whether the accounting treatment of government subsidy is correct. So whatever government subsidy is received, the company is booking the same as revenue. Is it correct? What needs to be done? Jagdish, your answer is incorrect. It cannot be called as other operating revenue. Subsidy received cannot be called as other operating revenue. So this answer is wrong. Vishali ji, you say no. Then what would be the correct scenario? G. Pavan Kumar ji says other income. Okay. Deepika ji says government grants, but with a question mark. So I don't know whether you're asking or you are questioning. Okay. So first of all, we need to understand for accounting of government grants, AS 9 is not applicable. Ind AS 115 is not applicable. AS 9 deals with revenue recognition. Ind AS 115 deals with recognition of revenue from contracts with customers. For government grants, what is applicable is AS 20, sorry, AS 12 or Ind AS 20. If you refer accounting standard 12 or Ind AS 20, as the case may be, what do they say? They're common on this front. They say that government grants related to revenue should be recognized on a systematic basis in the profit and loss statement over the periods necessary to match them with the related cost which they are intended to compensate. Such grants should either be shown separately under other income or deducted in reporting the allied expense. Therefore, the Company Act should disclose the subsidy on fertilizers as other income or should net off the same from the expenditure incurred on the purchase of fertilizers. One thing is absolutely apparent over here. The apparent thing is it cannot be called as other operating revenue or the revenue of the company. It is other income, or otherwise it can be netted off with the corresponding expense. I believe this point is clear to each one of you. Chandrasekhar ji, you're right. But in my question, what is happening? There is no capital asset. Had there be a case of capital asset, then we would have reduced this amount from the capital asset itself. Shall I proceed further? Chandrasekhar ji, Deepika ji, I believe the points are clear. Jagdish ji, shall I proceed? Now you must have understood that this is not a part of operating revenue. It is a part of other income. Okay. See this one. An entity has a rule that no gratuity shall be payable to an employee if he or she leaves service before completion of 5 years. The company believes that no liability should be accrued for gratuity till the first 5 years of an employee. Is the contention of the company correct? So company is wrong here. And for this purpose, we have the opinion of expert advisory committee also, and just see what they stated. So I will read from second paragraph only. First paragraph is obviously repeated here. The benefit of gratuity although becomes payable after 5 years, but the obligation accrues over the period of 5 years. Hence, an entity must estimate the number of employees who will become eligible for gratuity depending upon the attrition percentage across different levels, and accordingly estimate the amount of provision required each year, even if employees are not eligible for gratuity as on date. This accounting is known as probability concept, whereby you need to account for the percentage of employees for which the benefit will or will not vest. Accordingly, provision should be created during the first 5 years of service as well. So I believe this point is clear to each one of you. Can you please tell me one interesting question I'm asking? Is there any exemption? Is there any exemption from actuarial valuation under AS 15? Is there any exemption from actuarial valuation under AS 15. AS 15 deals with employee benefits. So please remember, most of the people have a misconception that small companies, or I should say small and medium-sized companies, did not go for actuarial valuation. Please understand, there is no exemption. There is no exemption under AS 15 regarding actuarial valuation for any of the company. Some people have a misconception depending upon number of employees, 50 employees, more than 50 employees, less than 50 employees. There is no such concept. This concept was there in earlier days. Now this concept is no longer in existence. So if you are running a company, irrespective of number of employees, there is no exemption. Only one exemption is there, that if you are a small and medium-sized company, then you need not apply the discounting provisions for provision for defined benefit obligation. Actuarial exemption is not there. I believe this point is clear to each one of you, because most of you have given the correct replies only. So I'm proceeding further. See this question. A company is engaged in the business of manufacturing and sale of chemicals. The company borrowed funds for purchasing of assets in the preceding years. Interest cost on the borrowed funds was capitalized in accordance with the laws and regulations till the time of commercial production. Later on, after the start of commercial production, no interest was paid to lender because of the financial problems. During the current year, the company repaid the principal amount to the lenders, and as per the arrangement, the lenders waived off the interest which was already capitalized. I emphasize, the lenders waived off the interest which was already capitalized. The company recognized the waived interest as capital reserve. How should such interest waiver be treated in the books of account? Any answer? Yes, any answer? Ashish Kumar ji says other income, no. Parasmal ji says income, no. Chandrasekhar ji, your answer is correct. Reduction in capital asset. So correct answer is it must be a reduction from the capital asset. So it is not a part of revenue or income. It should be reduced from the cost of capital asset itself. Just see why and how. So the interest waiver cannot be recognized as capital reserve. Instead, the interest that has been capitalized as a part of historical cost of the asset and has subsequently been waived off should be reduced from the fixed asset cost and accumulated depreciation. The adjustment should be carried out as on the date of waiver. The rationale is that since the asset has been correctly capitalized based on the actual cost incurred, but subsequently not paid, the capitalized amount of the fixed asset should be reduced. This is the opinion of expert advisory committee as well. So the answers were mixed answers, but correct answer is reduce it from the capital asset carrying amount itself. Now, there is a question in Q&A by Vipin Bhansali ji. Is this required during first 5 years of company? Vipin ji, I believe you're asking about that gratuity wala question. The answer is yes, it is required, even during the first 5 years of the company. Now, consider this one. In the financial statement of a company F Limited, it has not disclosed any information to indicate that it has conducted any impairment test of its assets during the financial year. Is it a correct disclosure? The company has not disclosed any information about impairment test. Is it correct? So basically, the question itself is giving the answer. The answer is that you have to disclose whether you have carried out impairment testing or not, meaning thereby, as per AS 28 or Ind AS 36, as the case may be, an entity should assess at each balance sheet date whether there is any indication that an asset may be impaired. So an entity should disclose either its accounting policy in respect of impairment of assets or whether the entity has conducted impairment test during the financial year. In the instant case, F Limited also should disclose the same. So disclosure is required. The question was, for that matter, self-answering question. So from this whole discussion, I have covered the common mistakes in the financial statements. If you have any question on this front, you are most welcome to ask. Immediately after your permission, I will start the next topic given to me, NFRA observation. So Chairman, sir, if any question is there on common mistakes in financial statements, I will be happy to answer.
Okay, sir. Sir, if you want, you can take 10 minutes break and we can rejoin, sir.
I was about to request you, give me a break of 10 minutes.
Sir, please, sir.
So with the permission of audience, let me take the break of 10 minutes. By my watch, it is 6:56. So we'll start sharply at 7:05.
Yes, sir. Yes, sir. Yes, sir.
Dinesh ji, yeah, presentation I will be sharing with the chairman sir, and then chairman sir may be kind enough to share with the participants.
We'll share, sir. We'll share, sir.
So immediately after this break, I will commence at 7:05 p.m. and I will discuss NFRA observations. If you have any questions, even on this very topic after some time, you are most welcome to ask that time.
Okay, sir. Okay.
For chairman sir, I am coming within 10 minutes.
Okay, sir. Okay, sir. Please, sir.
Shall we start, Chairman, sir?
Yes, sir. Please, sir. We'll start, sir.
Sharing my screen again. So the next topic for me is NFRA's observations. And I must tell you, each and every piece of this observation is quite critical. You will find most of the chartered accountants who are your friends, and maybe even you, are committing this kind of mistake, which NFRA has observed in other cases. What I have done is I have taken all these observations from some of the NFRA's orders in past. And these orders, as I told you, are the mistakes committed by others. And we can always learn from other people's mistakes. So to begin with, we have to discuss some observations. To begin with, the observation number 1. So first observation is about failure to comply with auditing standards and Ind AS. SA stands for Standards on Auditing. So what happened? NFRA in its order NF 2346/2021, these observations are there. A chartered accountant was appointed as an auditor in case of Vikas WSP Limited. This company, Vikas WSP Limited, is a listed company. So the auditor was appointed for this company, Vikas WSP Limited, but this auditor failed to conduct the audit in accordance with the standards on auditing, but falsely reported in his audit report that audit was conducted as per SCs. If you try to recollect the format of audit report, in the audit report, we are writing a paragraph. We report that we have complied with the ethical requirements and the requirements of applicable standards on auditing. So when you're writing this kind of paragraph, in a way, you are declaring in your audit report that you have complied with these standards on auditing. But when NFRA examined the working papers of this auditor with respect to this company, Vikas WSP Limited, they noticed that auditing standards are not complied with. So what happened? The audit report, whereby you are writing that SCs have been complied with, became a false report. More importantly, the NFRA also observed that the chartered accountant failed to report the non-compliance of Ind AS 109 for accounting of bank borrowings on amortized cost basis. So in this case, what happened? The bank borrowings became NPA. And because bank borrowings became NPA, the company stopped to provide interest on these bank borrowings. So the NFRA stated that even if the account has become NPA, that doesn't mean that interest will not accrue as per Ind AS 109 principles. So these two contraventions were prime contraventions committed by the auditor. And by virtue of this NFRA order, the charges were proved against this chartered accountant, and a penalty of ₹3 lakhs was imposed upon him. And he was also debarred for 3 years from being appointed as an internal auditor or statutory auditor or undertaking any audit in respect of financial statements or internal audit functions and activities of any company or body corporate. So prime contraventions were failure to comply with the auditing standards and failure to comply with Ind AS 109 for accounting of bank borrowings. The story is not yet over. In the same NFRA order, another observation was about non-appointment of engagement quality control reviewer. This is one of the serious discrepancy, or I should say serious mistake the auditors are committing. So if you refer para number 19, clause A of Standard on Auditing 220, it states that for the audits of financial statements of listed entities, the engagement partner shall determine that an engagement quality control reviewer has been appointed. So meaning thereby, if you are the auditor of a listed company, then you have to appoint a CA in practice as engagement quality control reviewer. So like I am reviewer for many CA firms as engagement quality control reviewer. In the same way, Srinivasa sir can be engagement quality control reviewer for your firm. I can be reviewer for your firm. You can be reviewer for my firm, and so on. So this appointment of engagement quality control reviewer is a mandate given by SA 220 para number 19A. And this mandate is meant for the audits of financial statements of listed company. Now what NFRA observed, this company Vikas WSP Limited is a listed entity. And thus it was mandatory for the auditor of this company to engage an engagement quality control reviewer partner for review of the audit work. And because the auditor failed in such kind of appointment, the penalty was levied and he was debarred also. Now, from this very NFRA order, 3 observations are coming up. Observation number 1, failure to comply with the auditing standards. Observation number 2, failure to comply with the Ind AS. And observation number 3, failure to appoint engagement quality control reviewer. These three prime observations are there. Obviously, some other observations were also there, but I'm touching upon the main observations only. So three prime observations were there in case of Vikas WSP Limited statutory audit. From this very NFRA order, if you have any queries, you are most welcome to ask. I proceed further otherwise. Now, there was other company, Prabhu Steel Industries Limited, PSIL. Prabhu Steel Industries Limited, PSIL, is also a listed company. In this very case, the CA was found guilty for the following reasons. Number one, PSIL had not complied with the Ind AS reporting framework and applicable provisions of the Companies Act in preparation and presentation of its financial statements. So what happened here, the company was a listed company and was required to prepare financial statements as per Ind AS. Despite this fact and requirement, the financial statements were prepared as per accounting standards. So Ind AS were applicable, but financial statements were prepared as per accounting standards. So what happened? When financial statements are as per accounting standards and not as per the requirements of Ind AS, primarily the entire set of financial statements are non-Ind AS compliant. Despite this fact, the CA reported that everything is true and fair, meaning thereby NFRA observed that CA failed to disclose in his audit report material misstatements and non-compliances made by the company in the financial statements in the areas of debtors, loans and advances, property, plant and equipment, inventory, and other account balances. Primarily, NFRA is all right also. When Ind AS have not been followed, rather AS have been followed, almost all the line items are misstated, but CA failed to report the same. Further, he was also held guilty for this reason. He failed to conduct audit in accordance with the standards of auditing and applicable regulations, but falsely reported in his audit report that audit was carried out as per essays. One common mistake, which is there again, no engagement quality control review was also conducted. So no EQCR, that is engagement quality control review, was conducted. Why it was not conducted? Because this CA has not appointed engagement quality control reviewer. So it is a violation of SC 220. We have discussed this thing in previous slide also. So why the NFRA order, this one, penalty of ₹1 lakh was imposed upon the CA and he was debarred for 1 year from being appointed as auditor, etc., etc. So you can see again, 2-3 observations are quite common. Observation number 1 is failure to comply with the auditing standards. Observation number 2 is non-appointment of engagement quality control reviewer. And in this case, observation number 3 is kind of gross negligence. What is the gross negligence here? The chartered accountant failed to report that financial statements are misstated because Ind AS was applicable and the company still follows AS. So this kind of discrepancy was noticed by NFRA, and then the repercussions as a matter of penalty action has taken place. Then other company was there, TDML, that is Trilogic Digital Media Limited. It is also a listed company. Again, some false reportings were there. The CA was found guilty for false reporting in the independent audit report, as he reported that he had audited the cash flow statement and it gave a true and fair view, whereas the financial statements submitted by the CA and the annual report downloaded from BSC website did not contain cash flow statement. So primarily, in my personal opinion, perhaps this report issued by the chartered accountant was a copied, edited and pasted audit report. Because the audit report stated that cash flow statement is prepared and presented by the company and it is reflecting true and fair view. But de facto, whatever financial statement was submitted at any level, they were not containing cash flow statement. So this is one of the discrepancy. Then TDML was registered under the CA reported. So in CARO, that is CARO 2016, that time, the chartered accountant reported that TDML was registered under section 45IA of Reserve Bank of India Act, applicable for non-banking financial corporations, and was holding a registration certificate for the same. So what the chartered accountant is reporting that TDML is NBFC and is having registration certificate from RBI. But in reality, if you see here, in fact, as seen from the annual report, TDML was in the business of media and content syndication and not an NBFC. So TDML was not registered under RBI Act and was not holding any such RC. So this is the kind of, again, a gross negligence, no? So further, what NFRA observed, he also failed to recognize the possibility of risk of material misstatement due to fraud in respect of recognition of abnormal expenses of sundry balances written off worth rupees 14.87 crores and other miscellaneous expenses worth rupees 24.606 crores. So sundry balances written off to this much of extent, miscellaneous expenses, this much of extent, were quite abnormal in nature. But what happened? The auditor ignored the risk of material misstatements over here, and he didn't report anything about these expenses. So what happened? NFRA ordered otherwise, that CA is guilty. The story is not yet over. NFRA observed that the CA also failed to obtain sufficient appropriate audit evidence regarding management's use of going concern assumption in preparation of financial statements, despite several adverse indicators in the financial statements that could raise significant doubt about going concern assumption and management's intentions to continue operations. So what happened? The NFRA examined the working papers. The NFRA examined the working papers of the chartered accountant. And when they examined the working papers, they found no kind of evaluation. They found no evaluation as to whether the auditor has assessed or not the appropriateness of going concern assumption. So working papers were deficient. NFRA also observed that he has also failed to perform audit procedures to identify, assess, and respond to the risk of material misstatements arising from related party transactions, RPT. TDML was required to disclose the name, transaction, and outstanding balance in respect of all RPs in accordance with AS 18. TDML had not disclosed names of all RPs except that of the managing director, despite evidence in the annual report that TDML had other executive directors and there were frequent changes in directorship of TDML. Further, TDML has also not disclosed any transaction with related parties, despite the fact that there were evidence in the audit file, that is working papers, regarding RPTs such as loan transaction of 1.40 crores and salary expenditure of 25.6 lakhs with wife of MD. Further, audit work papers indicate question being raised about RP status of trade payables to three parties. There was no evidence, although, that these were resolved. So what is happening? In working papers, you have the information about RPTs, but the same is not there in the disclosed notes of company. So that means the auditor was hand in glove with the company for non-disclosure and non-reporting of these kind of RPTs, and hence the NFRA liability penalty and debarration. The story is not yet over. The CA was also charged with the failure to report non-compliance with Division 1 of Schedule 3rd. Just a few minutes back, we discussed Schedule 3. So CA was also charged with the failure to report non-compliance with Division 1 of Schedule 3 of the Act. The shortcomings in this regard are as follows. Deferred tax assets, which were required to be classified as non-current assets, are classified as current assets. We discussed today itself. Other discrepancy of Schedule 3, which NFRA noticed, was cost of materials consumed, purchase of stock in trade, changes in inventories of finished products, work in progress, and stock in trade were to be presented on the face of statement of P&L, but they have been shown in notes to accounts. Then other discrepancy was wrong figure of earning per share has been reported. So, these small shortcomings are big shortcomings from NFRA's perspective. So NFRA, when went through the working papers and financial statements and audit report, found the CA guilty, and penalty of 5 lakh rupees was imposed, and he was debarred from practice as well. The story is not over. Some more cases under the belt of NFRA are as follows. I told you that para number 19A of SA 220 says, if you are the auditor of listed entity, then you have to appoint engagement quality control reviewer. So the question arises whether engagement quality control reviewer is outside the scope of NFRA. Answer is no. Engagement quality control reviewer is within the scope of NFRA also. So NFRA has clutches not only on the auditors, but also the engagement quality control reviewers appointed by the auditors. So NFRA order stated that mere ticking yes or no by engagement quality control review partner will not do. Audit file must evidence his independent analysis and workings with respect to work done by the engagement team. So basically what NFRA observed, NFRA stated that para 6 of SQC1, SQC1 stands for Standard on Quality Control 1. Para 6 of SQC1 defines engagement quality control review as a process designed to provide an objective evaluation before audit report is issued of the significant judgments of the engagement team. Engagement team means your article assistants and your paid assistants made, and the conclusions they reached in formulating the audit report. The process requires objective evaluation and separate working for evaluating significant judgments and verifying the audit results. The work papers in the audit file must evidence independent review and workings done by EQCR team, and also must evidence the minutes of discussion between EQCR and engagement partner, where EQCR relied on audit work papers and adopted a mere yes or no checkbox ticking approach, and audit working papers bore no evidence of independent analysis or working by EQCR, and multiple working papers were reviewed and signed by EQCR on the same day without any independent analysis or review, EQCR was also held guilty of gross negligence and absence of due diligence under Chartered Accountants Act. So please understand, if you're appointing me, Srinivasa sir, or Srinivasa sir or me are appointing you as our engagement quality control reviewer, then even all these reviewers are in the clutches of NFRA by virtue of Chartered Accountants Act applicable upon them as well. So by a NFRA order, what had happened, CA failed to maintain documents that he was statutorily obliged to maintain. He cited computer system issues, which was found unacceptable. So substantial deficiencies in audit is a professional misconduct. So even the chartered accountant failed to maintain documentation. So what happened? Emails were exchanged. Some other information was exchanged via media, but this was not documented. When question was asked, he stated that computer system was a failure. This is not acceptable because as per SQC1, you have to maintain documentation at least for 7 years. So again, what happened? The NFRA punished the chartered accountant. Now, one of the landmark audit quality review report, which was issued by NFRA for the first time, was in the case of IL&FS, Infrastructure Leasing and Financial Services Limited case. This audit quality review report, I must say, is a landmark report and is a beneficial literature for each one of the auditor. People like you and me can refer this report and learn a lot. So I'm sharing some of the major observations from this audit quality review report of IL&FS issued by NFRA for the year 17-18. So these are the observations, very much self-explanatory observations. I am simply reading. If you have any questions, you're most welcome to ask. I have tried to make the English language very simple over here so that the things become self-explanatory. So these are some of the observations. Observation number 1. The audit firm and its associates received non-audit service fees. The audit firm and its associates received non-audit service fees amounting to rupees 4.57 crore in 4 years, commencing from year 15-16, as opposed to audit fees revenue of rupees 2.3 crores received for conducting the stat audit of year ending on financial year 2018. This brings out the financial interest of the audit firm in the whole IL&FS group and showcases the dependence of the audit firm on total fees generated from IL&FS group. You know very well, even our code of ethics says that fees from non-audit services shall not be more than the fees from audit services. But in this case, it was not happening and hence CA was guilty. More importantly, the total value of investments shown in the standalone financial statements of IL&FS as on such and such date amounted to rupees 12,320 crores, which is almost 50% of its balance sheet size. The audit file and supporting documentation is the key evidence of the audit. It was observed in the report that audit firm failed to obtain the board approved investment policy as important audit evidence to understand and verify whether investment made by the company were as per company's policy or not. No evidence was found in the audit file which shows that the audit firm had verified if the management has tested each investment for impairment. Also, no evidence available in the audit file to show that the audit firm had communicated anything related to non-performance of impairment testing by the management to TCWG based on the examination. So what happened? The chartered accountant firm appointed as auditor failed to see the compliance of Ind AS 109 vis-a-vis these investments. No impairment was provided, no impairment testing was carried out, no policy for investment making was found by the NFRA. Can you please tell me the section number? Section number dealing with this investment made by the company. If there are normal companies, then we have section number 186. But this is the case of NBFC. So for NBFC, you have prudential norms issued by Reserve Bank of India. Then some more observations. The audit firm had relied on valuation reports issued by the management experts as audit evidence to value the investments, but there was no record in the audit file of any evidence about the objective valuation with respect to the work assigned in the audit file and as to whether the competence of expert was examined vis-a-vis his previous experience in dealing with such objects. So what happened? Management appointed an expert for the purpose of valuation, and the auditor relied upon the valuer's report without examining whether this expert is independent or not, whether this expert is competent or not, and so on. Similarly, the audit firm ignored the visible impairment indicators such as insolvency proceedings, negative net worth, etc., of component entities and did not report any non-provision of impairment by the company. This has resulted in non-reporting of the overstatement of profit of company for the year so and so. More importantly, the auditor also engaged experts, but it was observed by NFRA that audit firm did not comply with the requirements of SA 620. SA 620 deals with using the work of expert, as there is no evidence in the audit file as to whether any two-way communication took place between the audit firm and the auditor's expert. It was also observed that audit firm did not identify and assess the risk of material misstatement in the financial statement as per the requirements of SA 315 and failure to test the entity level controls and also failed to perform IT audit effectively. So if in your working paper files, in audit report you're writing, internal controls are good or bad. But if in your working papers, there is no assessment sheet, how you assessed whether internal controls are good or bad, then you are also guilty of professional misconduct. The same thing is limelighted by NFRA here in this case also, that you are reporting something in audit report, but the relevant evidence, relevant documentation is not there. And that's why the chartered accountants were held guilty in case of ILFS as well. I'm sharing other screen for some case studies. Please try to respond these case studies because these are based upon NFRA issues only. So to make you people understand NFRA issues, I have attempted to make some hypothetical case studies, but based upon NFRA's observations only. So case study number 1, I need the answers from you people. Number 1 case study is, Mr. X is the auditor of ABC Private Limited for the financial year 21-22. He is of the opinion that there is no need to wait and gather external confirmations because it involves much time and cost. In the notes to accounts, however, the management disclosed that certain debtors and creditors balances are subject to confirmation. So please respond back. What is your answer? What are the auditor's consideration that need to be taken care of? Yes, any answer? But there are 2 questions within this case study. Question number 1, auditor says there is no need to wait and gather external confirmations. And question number 2 is, in notes to accounts, the management has disclosed that certain debtors and creditors balances are subject to confirmation. Yes, what is your viewpoint as an auditor? Any answer? Let me see the chat box. So Parasmalji says qualification depending upon materiality, okay. Need to report in the audit report, okay. So as far as your answer regarding qualification is concerned, I agree. So if in notes to accounts, management is referring that debtors and creditors balances are subject to confirmation, obviously will qualify the report depending upon the materiality involved. That I agree. But about the first part of the question, where auditor says there is no need to gather the confirmation because it involves time and cost. Prasanna ji, your answer is also correct. Chandrasekhar ji, your answer is also correct. But the fact is, what is the reason? How auditor is going wrong when he says that I will not obtain this information because it involves much time and cost. So please take a note. Please take a note. By virtue of section number 143 subsection 3, auditors are required to obtain necessary audit evidence. So if you will refer section number 143 subsection 3 clause A, section number 143 subsection 3 clause A says auditors have to report whether they have sought and obtained information necessary for the purpose of audit. Are you able to recollect these words? Section number 143 subsection 3 clause A says auditors have to report whether they have sought and obtained information necessary for the purpose of audit. So that means it is the legal obligation on the auditors to obtain necessary audit evidence. Number 2nd note, SA number 505. SA number 505 deals with external confirmation. So time and cost factors cannot be the excuses. Time and cost factors cannot be the excuses for not obtaining sufficient and appropriate audit evidence. And that is the reason, in this very case, the auditors shall be deemed guilty of professional negligence if they have not obtained confirmations and if they have not qualified the report, considering the amounts were material in nature. I believe case study number 1 is clear to each one of you. If you have any doubt over here, you are most welcome to ask. There's a question from Parasmalji. Is there any threshold or do we need to get from all parties confirmation? Parasmalji, there is no need to obtain confirmation from all the parties. Only thing is we have to check the nature of parties and the amount involved. So depending upon the materiality, we have to seek confirmation. For example, With respect to MSME enterprises, it is always advisable to obtain confirmation because in Schedule 3, MSME disclosures are separate disclosures. In case of other than MSME, you can obtain confirmation only for the material amount. Now, what is material amount will depend upon case to case. Am I clear, Parasmalji? Shall I proceed further? Okay. Now, case study number 2. This is one of the good case study, and even NFRA observed on this front. The auditee client has provided rupees 2 lakhs as provision for bad and doubtful debts in the books of account, while the auditor is challenging this provision and opines that it should be rupees 5 lakhs. After much deliberation and consideration, both auditor and auditee concluded at a provision of rupees 4 lakhs. The auditor did not document these deliberations and considerations, as he is of the view that once he is satisfied, there is no need to keep any such record in his file. So what happened here? The client was of the view that provision for bad and doubtful debt should be rupees 2 lakhs. Auditor is of the view that it should be rupees 5 lakhs. They both discussed and then arrived at a conclusion that it should be rupees 4 lakhs. Auditor stated, when I am happy and client is happy for a particular matter, then why should I document? Now, please tell me whether auditor is right or wrong. And if you say right or if you say wrong, what is the reason? Yes, any answer? Any answer? Please take a note. Essay 230. Essay number 230. Essay number, yeah, Prasanna ji, you're right. Please take a note. We have essay number 230. Essay number 230 states that, listen very carefully, essay number 230 deals with audit documentation. Essay number 230 states that audit documentation comprises of 3 things: audit procedures applied, audit evidence obtained, and audit conclusions achieved during the course of audit. So what the standard is saying? Standard is saying that audit documentation comprises 3 elements: audit procedures, audit evidence, and audit conclusions. So if in this case study, auditor is not documenting the conclusion, then he also will fail to record the procedure and record the evidence on the basis of which he arrived at such conclusion. And it will be a professional misconduct for contravention of essay number 230. Am I clear? On this front, if you have any question, you're most welcome to ask. So you have to maintain the documentation even for those matters on which you are having the consensus with the client. I believe this point is clear to each one of you. Any question over here? If no question, then I should proceed further. Okay, let me proceed further then. Case study number 3. Be very careful what I am writing here. ABC and Company is a partnership firm. So it's not a company, it's a partnership firm. I'm going beyond NFRA observation, just as a matter of academic interest and professional interest. This question has nothing to do with NFRA, but still we must understand, because who knows, QRB may question you. QRB means Quality Review Board. So the question is, ABC and Company is a partnership firm. The depreciation was provided in the books of account in accordance with the rates prescribed under Income Tax Act. What audit considerations should be observed by the auditors in this regard? Yes, any answer? So ABC and Company is a partnership firm. As far as this partnership firm is concerned, the depreciation is provided as per income tax rate. Is there any mistake over here? And as an auditor, what you will consider? Accounting policy should be framed accordingly. Prasanna ji, accordingly means, can we go with the income tax rates? Answer is no. If you will go with the income tax rate and we will not qualify the report, professional misconduct. Please take a note. ICAI made an announcement about applicability of accounting standards on non-corporate entities. And because of that announcement, in books of accounts of non-corporate entities, depreciation shall be provided as per useful life of the asset. So you cannot use income tax rates for the purpose of books of accounts. If any assessee, that is non-corporate assessee, is using income tax rates for the purpose of providing depreciation in the books of accounts, then as an auditor, you have to qualify the report. If you are not qualifying the report, that it is a contravention of AS 10 issued by ICAI, then you will be guilty of professional misconduct. Am I clear? Any question on this front? So for non-corporate entities, now accounting standards have been prescribed by ICAI. Ashish Kumarji, these are mandatory now. So if you will refer the preface to the accounting standards, these are mandatory. ICAI has stated, and when I say mandatory, mandatory means not for the partnership firm, mandatory for the chartered accountant. ICAI says, if your client of who you are the auditor is not complying with the accounting standards, we will not say anything to the client, but we will catch you. And how you will catch? You will catch because you are not qualifying the report. So ICAI requires only one thing, na? ICAI says if your client is not complying with these accounting standards, no problem. Simply qualify the report. So these accounting standards are mandatory to be complied with by the auditors as a matter of qualification if your client is not complying with the accounting norms. Am I clear, Ashish ji? So I can say as a layman, I can say that Institute of Chartered Accountants of India has made these accounting standards mandatory for even non-corporate entities, but in an indirect manner. Because quite obviously, as a tax auditor, you will call the partnership firm and will say, see, ICAI has made these standards mandatory for me. If you will not follow, I have to qualify the report. Then partnership firm will say, okay, don't qualify. I will change the method of depreciation and rates of depreciation accordingly. Then obviously things are indirectly getting applicable. Case study number 4. The statutory auditor of PQR Limited did not verify the physical existence of its fixed assets. They have taken a written management representation about the fact that the fixed assets have been verified by their own staff and are existing as shown in the fixed asset records. The statutory auditors relied upon the same, but later on it was traced that some fixed assets were in fact not existing on the balance sheet date. The auditors were charged of gross negligence and they are defending themselves under the cover of the declaration given by the management. So chartered accountant is saying that I have relied upon whatever management stated and hence I am not guilty because management declared that they have themselves verified the fixed assets. So can I say that auditors are right? There's a question from A. Supraja ji. Even if the audit is conducted only under Income Tax Act, do we need to qualify? Answer is yes, Supraja sir. You have to qualify the Form 3CB for that matter. I got the answer from Prashottama ji. Answer is no, yes. So auditors are wrong in this case study number 4. Please take a note. As per SA number 580, written representations given by the management are not the absolute evidences, It is only one kind of audit evidence. Despite management representations being received by you, you have to apply your own audit procedures. I emphasize your own audit procedures separately from management representations to ensure that their assets were in existence. So you have to corroborate the existence of the fixed assets. Am I clear? So auditor in this case study is wrong. Just give me one moment. Yes, Supraja ji, shall I proceed further? Whether your query is answered? So even as a tax auditor, you have to qualify Form 3CB. I am proceeding further. Avinash ji, you have asked the question in the Q&A. Is this applicable even in case of 44AB? Answer is yes, it is applicable even in case of 44AB. Even the guidance note on tax audit says the same thing. Yes, Supraja sir, I asked for the depreciation. So for depreciation, I believe the question is answered to you. Okay. Case number 5. I will skip this case number 5 because it is not in connection with audit. Although when I will send this PPT, you will be understanding this thing. So I am skipping this one because it is not in relation to audit. Case number 6. Mr. A is the principal auditor of XYZ Limited. Mr. B is the auditor of branch of this company. Mr. B has issued a qualified report for this branch. Mr. A is of the opinion that he is not required to consider the opinion of other auditor. Is Mr. A right? Mr. A says, I am not duty bound. I repeat, Mr. A says, I am not duty bound to consider the report given by branch auditor. Is Mr. A right? Is somewhere written in the law that main auditor is duty bound to consider the branch auditor's report? So when you say answer no is correct. But can you please tell me where is somewhere it is written that main auditor has to consider branch audit report? Answer is yes. Please take a note. We do have section number 143 subsection 3. Section number 143 subsection 3 says that the statutory auditors have to report as to whether they have considered the branch auditor's report or not. As to whether they have considered branch auditor's report or not. Similarly, we do have SA number 600 also. By virtue of SA 600, the statutory auditors, that is the main auditor, has to consider the branch audit report. So if I repeat, by virtue of section number 143 subsection 3 read with SA 600, the main auditor is duty bound to consider the branch auditor's report. And even otherwise, if you refer this question on a logical note, not on legal note, on a logical note, what happened? The branch auditor has issued a qualified report. Now, who knows that this qualification may have an overall impact on the entire report, and that is the reason even otherwise he has to consider this qualified report. So in this question, Mr. A is wrong. He has to consider the branch audit report. Next case study. ABC Limited is a listed company and has appointed 4 joint auditors for the financial year 21-22. 3 of these auditors have issued an unqualified report, but one of them has issued qualified report. The management of the company is contending that the majority opinion is binding upon individual auditor, and accordingly he cannot issue qualified report. So is the management right? So 4 auditors were there, 3 issued unqualified report, 1 issued qualified report. Management says because 3 are issuing clean report, the other one also needs to issue clean report. Is the management right? Yes, any answer? Answer is no. Please take a note. As per SA 299, SA 299 deals with joint audits. As per SA 299, majority opinion is not binding upon other auditors. That means each auditor has a right to issue his own individual independent opinion. So 3 auditors who are in majority cannot bind the other auditor who is in minority side. So majority opinion is not binding upon the other auditors, and he can issue his own individual report. Before I discuss the last case study number 8, I have a question. Without searching on Google, please reply me. Is there anything written? Is there anything written about joint audit in Companies Act and FEMA regulations? Is there anything written about joint audit under Companies Act and FEMA regulations? Because in other laws, joint audit is almost absent. I will not touch upon the bank audit. So what about Companies Act and FEMA regulations? Is there anything written about joint audit or joint auditors in Companies Act and FEMA regulations? Any answer? I will take 5-6 minutes, then we will wrap up. Any answer? Please take a note. We do have section number 139 of Companies Act. Section number 139 of Companies Act states that the members of the company may resolve, to appoint 2 or more auditors in such a manner that they are not retiring at the same time. So what is the point coming out? Companies Act is not mandating to appoint joint auditors. I repeat, Companies Act is not mandating to appoint joint auditors, but Companies Act says that if the members have resolved to appoint joint auditors, then they may resolve such appointment in such a manner that all the joint auditors are not retiring at the same time. That is one part of Companies Act. Now, coming to the second part is in FEMA regulations. When you will refer FEMA FDI regulations, foreign direct investment regulations, FEMA's FDI regulation states that if it is a condition kept by the foreign investor, that the audit of the investee needs to be carried out by any multinational firm, then such multinational firm also needs to appoint one domestic auditor. Let me share an example as a layman. Say Microsoft Networks USA invested in RST Private Limited India. Now RST Private Limited is having FDI from Microsoft USA. Now Microsoft USA put up a condition that I will make investment in your company, that is RST Private Limited, only when you will appoint KPMG as your statutory auditor. Now what happened? This RST Private Limited appointed KPMG as the statutory auditor. To that extent, it is the contractual fulfillment that RST did. Now, RST is also required to do a fulfillment on a legal front. RBI says in the regulations that in such a case, RST also needs to appoint a local firm as its statutory auditor. So this will be a case of joint audit. So whenever these kind of joint audits are coming in, then these joint auditors, I repeat, these joint auditors need to comply with SA number 299. SA number 299 deals with joint audits. So on this front, if you have any question, you are most welcome to ask. So let me come to the last case study. The senior partner of ABC and Associates, a CA firm, calls upon the audit assistant and instructed him to follow the same materiality level as adopted during the last year audit unless the internal control system has been deteriorated substantially. Comment. So basic question is, the chartered accountant is saying, as an auditor, he's saying that if internal control system is same, is not getting weak as compared to the past year, then you can follow same materiality level. Is it right? Can we keep the materiality level same if there is no change in internal control system? Is it right? So can you please tell me, Prasanna ji, what are the other factors other than internal control system on which determination of materiality is dependent? What are the other factors on which determination of materiality is dependent other than internal control system? And that is basically the question is. So materiality depends upon going concern, materiality depends upon legal requirements, materiality depends upon volume of transactions. So many factors can come up. So that means the simple answer is materiality needs to be reviewed for each year audit, irrespective of internal control system getting deteriorated or not. Am I clear? Any question on this front? So from my side, this is the whole story of discussion. I have tried my level best to capture as much as I can. If you have any queries, you're most welcome to ask. Else we can wrap up. Some time is left. So almost 8 to 10 minutes are there. If you have any queries, you're most welcome to ask. Let me stop the screen share meanwhile. So let me see the questions in the chat box. Thank you, Sivaraman sir, for the presentation compliments. Thank you, Vinashi. So I will take the compliments at a later stage, but if you have any questions, you are most welcome to ask. So if you have no question, let me ask you a GK based question. Because time is there, so I need to justify that time also. There is a GK based question for each one of you. The GK based question is, let us assume there is a company ABC Limited, and it is the 100% holding company of another company, and that another company is Section 8 company. I repeat, there is a company ABC Limited. ABC Limited is the holding company. Other is a Section 8 company. Let us keep the name ABC Foundation. ABC Foundation is a Section 8 company. ABC Limited is the wholly owned, ABC Foundation is the wholly owned subsidiary of ABC Limited. The basic question is, assume that ABC Limited is also having some other subsidiaries, and hence ABC Limited is preparing and presenting consolidated financial statements. The question arises whether ABC Limited also needs to consolidate ABC Foundation. Please remember that ABC Foundation is a Section 8 company. So in a single question way, the question is, in a single sentence, the question is whether Section 8 companies being subsidiaries need to be consolidated. Under AS and Ind AS hardly matters. So I got one answer from Baswana ji, yes. Okay. Any other answer? Whether Section 8 companies need to be consolidated. Yes. Any other participant? Because I got only one answer. So please listen my words and then decide whether consolidation will be made or not. If you refer Accounting Standard 21, Accounting Standard 21 says a subsidiary will not be consolidated if subsidiaries ability to transfer returns or funds to its members is adversely affected, is under restriction. So if subsidiary company cannot transfer the funds to its members, cannot distribute the funds to its members, then such subsidiary will not be consolidated. That is what AS 21 says. If I come to Ind AS, Ind AS 110 says that a subsidiary will not be having a control. A subsidiary will not be having a control if the holding company, is having no power, no entitlement to the returns earned by the subsidiary company. So no control is there, no consolidation is there. Now ask yourself a question: can sectioned company distribute profits to its the holding company? Answer is no. Sectioned company is not allowed to distribute profits to the members. Holding company is one of the member, no. So because sectioned company's ability to transfer funds to the holding company is affected adversely, number one. If I go to Ind AS, then under Ind AS, the holding company is having no entitlement to the returns earned by sectioned company subsidiary in both the cases, that is AS or Ind AS. Hence, what is the conclusion? The conclusion is consolidation will not be made. Am I clear, Baswanaji? So Avinashi, your answer is correct. No. The sectioned company cannot distribute profits, and hence consolidation will not be made if sectioned company is a subsidiary company. This is very important. Why it is important? If you refer schedule number 3, if you refer schedule number 3, it very categorically states that if you have any subsidiary which is not consolidated, then you have to disclose the reasons of non-consolidation. So in my example, if ABC Limited has not consolidated ABC Foundation, then ABC Limited in its financial statements needs to disclose the reasons for non-consolidation of Section 8 subsidiary company. I believe this point is clear to each one of you. So here I rest my speech and I conclude my session. I would request the managing committee to appear, and thank you very much, Srinivasa sir, for appearing. So if you have any questions, you're most welcome.
You all heard, sir. It was an excellent session, sir. It was so detailed, guiding, question by question.
Srinivasa sir, one question came up in between. There's a question from Nidhi Tatia ji, whether donation made to Section 8 company to be disclosed as RPT. Answer is yes. So Nidhi ji, this is required to be disclosed as RPT, and please remember, when this donation is made, perhaps you also need to comply with the section number 181 of Companies Act. So you can take a note. Disclosure is required under AS 18 or Ind AS 24, as the case may be. Plus, additionally, you also need to check the compliance of section number 181 of Companies Act. Yes, Srinivasa sir, from my side.
Excellent session, sir. No words to explain. It was so detailed, and all explanation given with sections and essays and all. Excellent session, sir. I thank on behalf of Bangalore branch of ICA for your time and efforts in sharing a valuable knowledge, sir. I also thank all the members who actively participated in all the entire session. Thank you all for your active participation. Thank you, sir.
Thank you, sir. Thank you very much, sir. So I would make an announcement towards the end. If you remember, when I was discussing, I told you that appointment of engagement quality control reviewer is mandatory if you are the auditor of listed companies. I would suggest each one of you, out of my experience, because I am doing this thing, you people as closed fraternity of chartered accountants can help each other. You can become client of other chartered accountant, and other chartered accountant can become client of yours. So this could be a kind of opportunity within our own fraternity. So that is the kind of announcement I wish to make, and I believe that this session will be fruitful for you in times to come and will help you in avoiding several mistakes. So I am thankful to Bangalore chapter for giving this opportunity, and my good friend Srinivasa sir.
Thank you, sir. Thank you a lot, sir.
Physically. Thank you, sir. Thank you. Thank you very much. Thank you very much, audience. Thank you very much.